20. So 1T. It's not coming. It is coming. Okay, cool.
Good morning. Just testing. That's okay. You can continue talking, having coffee. Thank you. Good morning, Jaco, you can sit now. So good morning and welcome to the launch of the Credit Reporting and Financial Inclusion Program, Phase 2, in collaboration with IFC and the National Credit Regulator, supported by SECO. We want to welcome and thank the participation and presence of several relevant and important guests that I am going to mention by name. Verushka Gilbert, representing the Department of Trade and Industry and Competition. Lynette De Beer, acting CEO of the NCR. Daniel Lachenauer, sorry, I always have problems. Head of Economic Cooperation and Development, Swiss Embassy. Dr. Nicola Brink, Director of Financial Stability. Mr. Michael Mamamola, Head of Economic and Statistics of SARBS. Representatives of other authorities, credit providers, credit bureaus. Thank you, everybody, for being here today. We're going to start with a brief introduction by Kedilatile Legodi, Acting Company Secretary of NCR, to set the scene and context of today. Then I will come back, introduce myself. In the meantime, I'm a ghost.
Good morning, everyone. I borrowed simple words, but very profound, with profound meaning, from the great man Henry Ford, and I would like to read them to you. Coming together is a beginning. Staying together is progress, and working together is a success. This quote, ladies and gentlemen, bears testimony to the effect of the partnership and collaboration that the NCR has with the International Finance Corporation. To add, the fact that you are all gathered here this morning goes to show how significant coming, staying, and working together is. But before we get started, it's my great honor to extend a warm welcome to everyone gathered in this room and those who are attending remotely to the launch of the South Africa, to the launch of Phase 2 of the South Africa Credit Reporting and Financial Inclusion Program, brought to you by the NCR in partnership with the IFC. Also would like to just acknowledge the following key stakeholders in attendance: leadership from the Department of Trade, Industry and Competition, the National Treasury, Department of Small Business Development, Department of Planning, Monitoring and Evaluation, the South African Reserve Bank, the Financial Sector Conduct Authority, Competition Commission, International Finance Corporation, leadership from the National Credit Regulator, and the various associations, and lastly, the State Secretariat for Economic Affairs for their support of this program. Some of you may be wondering why Phase 2 launch. So I will take a few steps backwards. The coming together of the NCR and the IFC dates to 2018, which gave birth to Phase 1 of the cooperation agreement, which was initiated in 2021 and concluded in 2023. The mutual goal of this partnership was and still remains to expand, diversify, enhance, and strengthen the mechanisms of sharing credit information to promote responsible lending practices in South Africa, and importantly, financial inclusion, particularly for the categories of individuals and businesses that to date remains excluded. And implementation of this agreement is phased in approach and includes various initiatives. As I've alluded to the fact that Phase 1 is already concluded, a reflection of this phase, the accomplishments from this phase will be shared as the activities of the day unfolds by the experts, so I do not want to spoil it for you, but please stay tuned. Today's event marks a significant milestone for the IFC and NCR of staying and working together on this journey towards enhancing credit reporting, improving access to credit, and fostering a more inclusive financial ecosystem. And it is indeed our pleasure to officially welcome you to the phase 2 of this program. Throughout the day, you'll hear more about the initiatives emerging from this program. These are remarkable initiatives with potential to transform the financial and credit landscape. Our agenda, as you may see, is designed to facilitate meaningful discussions, and we have an exceptional lineup of speakers and panelists, each bringing a wealth of knowledge, skill, experience, and insights that promise to enrich our understanding, inspire, and broaden perspective. To keep you recharged, as I've mentioned, the agenda is packed. Coffee breaks and lunch have been provided for. And as the formal program concludes later this afternoon, we invite you to stay and participate in a networking session to forge meaningful connections, explore potential partnerships, and identify synergies that can drive positive impact in the credit reporting and financial inclusion space. In closing, I would be making a mistake if I do not acknowledge and extend our heartfelt gratitude for the hard work and dedication of the organizing committee, who have spent countless hours ensuring that every detail is meticulously planned and executed. Ladies and gentlemen, thank you for joining us. Let's make the most of our time together, and may we stay and work together to achieve greater success in the improvement of credit reporting and financial inclusion. Thank you.
Thank you very much, Kedi. That was really nice. So my name is Luz Alamina, and you will see me coming in and out of this podium or from somewhere I will be speaking because I have been assigned the program director of today. I lead the credit infrastructure work in Africa for the IFC. I am also the secretariat, together with Colin, who I'm sure that most of you know, of the ICCR. The ICCR is the International Committee on Credit Reporting. It is the only recognized standard-setting body for credit information. It is chaired by the World Bank. The ICCR is composed of about 29 members, mostly regulatory authorities from G20 countries and others, and also joined by private sector credit information service providers represented by regional associations and entities like the World Bank, BIS, and others similar. The National Credit Regulator of South Africa is a founding member of the ICCR back in 2011, and the only African country member of the committee. In 2018, when Argentina held the G20 presidency, next year is the turn for South Africa, under the theme Building Consensus for Fair and Sustainable Development, the ICCR was tasked to draft policies based on the conclusions of a report called Alternative Data Transforming SME Finance. This report was published by the GPFI, the Global Partnership for Financial Inclusion. The premise of the study is that SMMEs and individuals generate vast amounts of digital data from financial and non-banking platforms, such as payment systems, mobile, money and phone, trade transactions, social networks, and others. Therefore, this so-called alternative data could be used to assess creditworthiness, capacity, and willingness to repay loans, particularly for those individuals and businesses that do not have credit reported in the bureaus. The policy guide included among its recommendations to pilot and test the use of alternative data and scores in a controlled environment. The NCR offered to the ICCR to lead such pilots in South Africa, where close to 6 million SMMEs remain credit constraints, and trusted us at the IFC to support them in this journey. Alternative data, you will see, is at the heart of the South Africa Credit Reporting and Financial Inclusion Program that we are launching today. SECO, the State Secretariat for Economic Affairs, is the partner that makes the program possible. SECO supports South Africa in promoting a more viable and resource-efficient private sector and reliable economic framework conditions. We are grateful to SECO for believing in this program and for their continued support. We have a packed agenda today, with presentations on accomplishments and learnings from the first phase, and a taste of the work that have already started in this second phase, with panel discussions to gather feedback from relevant stakeholders that can help us improve the activities planned to achieve the expected results. This is also an open invitation to all of you to participate in the studies, in the pilots, and bring other initiatives and collaborations to the table. The sessions are divided in 4 main topics: alternative data, small credit providers, business credit and risk reporting, BISCRI, and credit registries. For each topic, there will be presentations to provide background on them or report work that was completed in the previous phase, followed by panels to enrich the discussions and the future work. So to start the program, we welcome Lynette de Beer, Acting Chief Executive Officer of the National Credit Regulator, for her opening remarks.
Thank you very much, Luz. Before I start, I would like to introduce to you the representative of the DTIC, Varushka Gilbert. She is the Director of Credit Law and Policy at the DTIC.
Thank you so much, Lynette, for that introduction. Good morning to everybody present, distinguished guests. Just by way of introduction, I am Varushka Gilbert. I am from the Department of Trade and Industry. As Lynette has introduced me, I am the Director for Credit Law and Policy in the Regulation branch of the DTIC, and it's a branch that is focused on regulating industries such as gambling, lotteries, intellectual property, credit, and consumer, amongst others. I'm just going to briefly speak to 2 slides. This is very impromptu, so you'll pardon the mistakes along the way. I'm just going to focus on the DTIC's mandate and priority areas, the outcomes that we intend to achieve. And if we could have the first slide up on the DTIC, please. While we wait, I will just, in the meantime, continue. The DTIC is heavily focused on achieving its transformation agenda. And one of its focus areas includes employment and ownership, expanding of business opportunities through self-employment, and also promoting more equitable ownership of businesses for women, youth, and obviously we want to focus on growing small businesses. And we seek to achieve this through structural transformation initiatives and offering the necessary support to SMMEs. And I think this conference today is quite pivotal in achieving the DTIC's mandate. And it is useful to have this kind of information that we will see as the day runs by to understand the mechanics from an implementation perspective insofar as data sharing and consolidation is concerned. So we look forward to the day ahead. I think this conference actually gives meaning to the policies of the DTIC as we develop them, and it's certainly going to deepen our understanding of the credit realm. And we all know that credit is used as a catalyst for business expansion, and it's fundamental in facilitating the growth of small businesses. There was a slide speaking to the DTIC's industrial policy and strategy. And in particular, this should not necessarily be within the domain of the DTIC. Industrial strategy should be all of government effort that places inclusive growth and job creation at the center of its national agenda. And as we can see, we have an extension of the NCR and the IFC's initiative in contributing to the national agenda where this conference is concerned. But what exactly do we speak about when we say industrial strategy? Well, historically, it has been defined as the state's effort to shape the sectoral allocation of the economy and promote structural transformation by targeting specific industries and economic activities. And this is done through measures such as financial incentives, the use of targeted trade policies, establishing the necessary regulations, and implementing reforms, particularly for credit in this context of today, and looking to offer development support. I'm sure most of us are familiar with SACRA's initiative on the Business Credit and Risk Information Project, and the DTIC is happy to support SACRA in this regard, which facilitates the sharing of business credit and risk performance data. So we look forward to offering support. We look forward to further engagements to see how we can strengthen our respective partnerships and participate in initiatives to pilot projects and make the necessary reforms to achieve the aspirations of such initiatives. We think that it's important to support the integration of small credit providers into the credit reporting ecosystem to help them digitize. And we all know that such credit reporting systems are critical to strengthen the financial infrastructure of the country and ensure a fair and inclusive economy for all to participate, as well as a competitive credit market. Where regional and international trade is concerned, that's item number 2 there. The DTIC has been working in earnest towards the development of legal instruments such as the African Continental Free Trade Agreement. This agreement is aimed at broadening the African economic integration, improving Africa's competitiveness, and also ensuring an inclusive socio-economic development. This aims at promoting cooperation across the borders insofar as anti-competitive practices are concerned. It's also aimed at increasing intra-African trade and investment and promoting sustainable development, harmonizing the rules of digital trade, as well as offering support measures to women, youth, and small businesses to benefit from the African Continental Free Trade Agreement. Another outcome of the DTIC is industrialization, and through the work in the green economy, which is item number 3 there, the goal is to really build dynamic firms in the South African economy through a combination of efforts and in partnership with private sector that is focused on growing opportunities in the domestic market. And this is done through localization, sectoral partnerships, promoting the green economy, and fostering higher levels of investment. And we all know that through investment, there's job creations. We can address issues such as, poverty alleviation and reduce the unemployment rate of the country. The green economy also aims at creating a wider export market for Africa, and this will assist in building South Africa's industrial competitiveness and supporting job creation, as I've mentioned. In that regard, the DTIC wishes to congratulate the NCR and the IFC on this strategic partnership alliance And we look forward to engaging further and seeing how we can strengthen our partnership and achieve the goals set out for the day. Thank you so much.
Thank you so much, and thank you for this impromptu invitation to speak and to speak against hidden invisible slides. Great, thank you very much. So we got Lynette, the podium is yours.
Good morning yet again to everyone. We are going to go impromptu without the slides. My apologies for that. So I was just going to expand on the presentation that was done by the DTIC, also just to link that to the NCR's priorities. And those are also linked, obviously, to the mandate of the NCR. So our legislative mandate allows us to promote a fair, non-discriminatory marketplace for access to consumer credit. It also provides for general regulation of consumer credit and improved standards of consumer information. It prohibits certain unfair credit and credit marketing practices, promotes responsible credit granting and use, prohibits reckless credit granting, provide for debt restructuring in cases of over-indebtedness, regulates the credit information that we are custodian of, promote and a consistent enforcement framework relating to the consumer credit. Our registrants that we oversee are those of the credit providers, and that we do have more than 7,000 of, which has more than 40,000 branches in South Africa. We also look after the credit bureaus. We have 6 hosting credit bureaus, 4 niche credit bureaus, and 45 reseller credit bureaus. Then we do have 4 payment distribution agencies, 7 alternative dispute resolution agents, and 1,556 debt counselors. It's quite a number of registrants to manage within the capacity of the NCR. The distribution of credit granted to consumers are predominantly hosted in the Gauteng province, which consists of 41.15% of the total credit granted in South Africa, followed by the Western Cape, which is 18.69%, and thereafter the KZN province of 13%. So I know Luz has already touched on the IFC Corporation engagement that they have with the NCR. I'm not going to go into that much detail, other than to say that first one phase was successful. And the objective of that engagement at the time was just as we came out of COVID-19, you will remember there were quite a number of uncertainties with regards to credit granting at that time. That's where we engaged, and the objectives at the time was the onboarding of the category 6 to 9 credit providers, which are mostly in those of the microfinance institutions, and also then to promote adoption and usage of alternative data and support for the establishment of a public registry. So we have made significant strides in, and the team will update you shortly after my presentation. And the success that we have should be looked at beyond the numbers, please. But it must be looked at the work that we've done, not only on the beneficiaries that we have, but also for us as an institution. Implementing the tech sprint was one of our important milestones. And in our innovation journey as an organization, we will also hear from the speakers on that today. So building onto phase 1 and the successes thereof, the NCR and IFC has now engaged in another engagement for the next few years. We are very grateful to the State Secretariat for Economic Affairs and the IFC for their long-standing support and commitment in this project. The phase 2 project will include some carryovers, as I think Luz has already alluded to. And then there will always also be new relevant categories and activities in there. One of them is the scaling of the alternative data sources of thin file individuals and SMMEs, deployment of the credit registry now, and then the SMMEs commercial credit reporting, gender inclusive or differentiated creditworthiness assessments will also fall in phase 2. The technology oversight and the explainability of credit underwriting scores and models. And again, also very important, the cross-border credit information sharing. And lastly, it will also assist us with automation and capacity building of the NCR, which is very important. Again, I'm very thankful and thank you very much for all the speakers and the partners who have contributed in this work. But again, I'm looking forward to recruit more of you to partner with us on this journey, to build an inclusive financial sector and enhance the data-driven policy making. We are convinced that these reforms will contribute to improving doing business, unlocking private sector investment, job creation, and promote growth. I look forward to the successful implementation of this phase, and we will be actively communicating the progress thereon. Thank you very much.
Thank you very much, Lynette. Sorry for the slides. Let's welcome the Head of Economic Cooperation and Development of the Swiss Embassy in South Africa. Daniel will open the session and then we'll start our work.
Thank you very much. Veruschka Gilbert from the DTIC, Lynette de Beers, Acting Chief Executive Officer of NCR, Executive Management Team of NCR, IFC Management and Staff. Always a pleasure to work with you, Luz. I think we know each other we met in Ghana first time, and you told me a lot about credit reporting and all these things. I learned a lot. Yeah. Representatives from other government departments, including the Reserve Bank, representatives from other regulatory agencies, distinguished guests, ladies and gentlemen, a warm welcome to the launch of the South African Credit Reporting and Financial Inclusion Program. The launch is part of efforts aimed at enhancing the resilience of the credit information system to promote financial inclusion. I want to thank the national credit regulators and IFC for hosting this launch and for such a strong and impressive representation. This second phase builds on the foundation work that the IFC and NCR have been working on over the past 3 years to improve the credit reporting system in South Africa. I'm informed that we'll receive some updates on the work that's been underway. Let me explain very briefly where I'm coming from. What is SECO? What is Switzerland doing here? Maybe you are surprised to have seen the Swiss cross here. SECO, or the State Secretariat of Economic Affairs, is part of the government of Switzerland. And among other roles, we are in charge of implementing Switzerland Economic Development Corporation. So it's part of Switzerland's development corporation, but with a clear focus on economic development. And SECO is active in a number of selected countries. Countries are selected based on the importance for Switzerland, if you wish so. South Africa is the biggest trading partner of Switzerland. South Africa and Switzerland share many common visions and ideas. And there has been a long-standing diplomatic relationship between the two countries. And these are the reasons why Switzerland decided, our parliament at the end of the day decided, many years ago already, to nominate South Africa as a priority country for Switzerland's economic development. I'm sitting in the embassy, in charge of a small team, and overseeing basically this economic development cooperation, which has been formulated before, aims at supporting reform initiatives of the South African government, of the South African businesses, towards a stronger, a better functioning economy, basically, and creating more jobs at the end of the day. We always look at framework conditions. We look at the private sector to use the systems in place and support this. In this, maybe not completely surprising for Switzerland, having some well, a bit less now, but having still some big banks. One we had to sell somehow. But anyway, that's a different topic. But access to finance is a critical, and financial sector access to finance is a critical sector for us. So that's where this initiative is coming in. And in particular, the focus on MSMEs is crucial. South African's economy is made up of MSMEs. 98% or something like that are of the companies, the registered companies are medium-sized and small enterprises. They are crucial they employ more than 50% of the workforce. They generate about 1/3 of the GDP. They're absolutely crucial. And they face challenges, particularly on access to finance. At least since the load shedding is a bit less of a major challenge, we can focus on other challenges. So about 75% of their credit applications are rejected. And only about 2% of new MSMEs can access bank loans. So crucial to do something, to work on that. And if an organization like National Credit, NCR is working on that, we are happy to support. But the finance gap is attributed to a lack of data, collateral, and limited sources of alternative finance. At the macro level, the financial sector regulators do not have sufficiently access to granular data on the credit markets to influence policy making and data-driven decision making. So I'm really pleased that we can support this partnership between NCR and IFC to address some of these challenges. We believe that access to finance contributes to the development of the private sector and creation of decent jobs. We also believe that leveraging advances in technology and innovative creditworthiness assessment solutions can help unlock finance to marginalized segments, including women. Switzerland, SECO, through funding support to the IFC, is supporting the NCR through a multi-year project aimed at promoting responsible lending to MSMEs, especially underserved segments, including women, townships, and youth enterprises. Through 3 main areas: strengthening the credit reporting system, develop enabling framework for secure transactions and asset-based lending, and enhancing insolvency and debt regulation regimes. We are happy today to be attending the launch of one of these projects, South African's Credit Reporting and Financial Inclusion Program, second phase, which strengthens the credit reporting in South Africa. The project is comprised of several components designed to improving visibility of individuals and SMEs, promoting business credit reporting, and address issues of technological oversights. We are happy to see that the project will also address topical issues such as promoting access to women, addressing issues of cross-border information sharing. The activities in the automation of the NCR and deployment of the credit register will ensure that the regulatory agencies will be equipped to deal with evolving financial landscape. I'm encouraged to see that there is considerable work has already been done into the launch and kicking off of the new phase. I'm told for this launch, the team has lined up several informative sessions and distinguished speakers to share their views and experience in several subjects that will form a foundation of the Phase 2 project. I would like to thank all the speakers for sharing their views, experience with us. I hope these sessions will not only stimulate discussions, but will also be an opportunity to invite some of the stakeholders here in the room to actively participate and collaborate in the project. I'm positive that the planned activities under this project will help in promoting financial inclusion, contribute to addressing issues such as transformation and job creation. It will also enhance the capacity of the regulatory agencies. With that, let me thank you for the participation at this launch. I look forward to fruitful discussions and deliberations. Thank you very much.
Thank you. Thank you very much, Daniel, Lynette, for the opening remarks. Our DTI representative. We're going to start. Now I present myself. We are going to start with a brief presentation of What are the components? What were the components of phase one? What is we can expect for phase two? And then we will delve into the main topics of today. So the context hasn't changed for a while. And these, let's say, problem statements are the inspiration of the projects that we developed here in South Africa. Even though this study is from 2018, there's still close, or maybe more now, than 6 million MSMEs that are without access to credit. Therefore, there are many more that don't have jobs. And this is what IFC, what SECO, what NCR, DTIC, we are trying to find solutions, and we're willing to test anything that sounds logical to resolve this problem that is not only South Africa's, it's really all across the world. This is where our alternative data comes in, and we are really believing that it's going to make a difference going forward. In addition to that, in South Africa, we have the greatest number of credit bureaus in the world, I think. And you actually manage well. And there is a lot of information, and there is a lot of information on individuals. There are some gaps in the regulation that limits access to information for businesses to come into the bureau. That is another issue that we want to address as well, work together with all of you, with the authorities, if there are gaps that can be resolved, whether through regulation or operationalizing the private sector to promote access, then that's the way we want to go. There are small credit providers that are small businesses themselves that also lack the right technology, are not at the standards to comply with regulations, and to expand lending to the segment that we want to address. That is another problem, another issue that we want to address. So what are the components of the two phases? In phase one, which we just finished, we talked about the alternative data, expanding the credit information sharing through onboarding these small credit providers that we're talking about, support the establishment of a public credit registry, at least start designing a roadmap. We worked on measures to safeguard the integrity of the credit reporting system. This was born from COVID. And in phase two, we want to add to those the project on BISCRI. Since I moved to South Africa, I live in South Africa, you know? I live in South Africa for 5 years, since 2014. And I was introduced to BISCRI in 2014. So we want to work together to make sure that small businesses, businesses in general, are brought into the databases of the bureau so that they can also be part of the ecosystem. Scaling up and adoption of alternative data scores. Second phase, we are going to see what's happened with the pilots that took place, what are the learnings, and how to scale that up. And we hope to be back here 3 years from now and show that impact in millions, billions. The credit registry, is basically a mandate from Section 69. There is a lot of work to do there, and there is a lot of promises from this exercise for the ecosystem in general, for the regulators in particular, to have access to information that will allow them to monitor the credit performance of the whole economy, to promote policy, to contribute to the micro and macro prudential regulations. For this, we also want to, or NCR is willing to go through the automation status, improve the automation because technology is everything. Data needs technology to be used, and use technology also for oversight, for monitoring, for statistical reporting, for NCR, but also for the rest of the authorities. And there are some additional topics of interest that we want to work with the team. I have talked about this already, but to go a bit deeper on what happened in phase one, small credit providers, like Lynette indicated, that over 7,000 registered in NCR, about 6,000 around are small businesses themselves. And they are struggling to meet the demands of the regulator and even to meet the demands of their own operations. So the first step is onboarding them, understanding what they are, getting the data from them, and then look for your solutions. NCR has been very innovative in launching the first tech sprint in Africa with a lot of learnings that you will hear later on. We're very proud and very grateful that you took that step. Inviting anyone that has solutions to come and support these small credit providers to bring them to a higher level in technology for both compliance, of course, but for their own growth and therefore the growth of the rest of the economy. So for this, we did also capacity building, and at the last statistics we got, additional 1,200 small lenders that were registered are now onboarded. We want to continue this work with any entity that wants to be part of creating solutions for these small lenders. Those that already provide solutions, if there is in any way that we can also contribute to enhancing your solutions, to go even and provide them to even the smaller ones, we are here to listen to you and collaborate with you. On alternative data, I think a lot has been said and a lot more is going to be heard here. The first thing we did was an assessment of what data is available in South Africa that is not the traditional credit information. A lot of interesting and availability of data that is already digitized. And NCR was also very good at leading a process of piloting. There were 2 pilots in this first phase. We really hope to have many more. There are some amazing learnings that you will see and hear about them later on. On public credit registry, the public credit registry, this is the Section 69 of the National Credit Act. It defines the National Credit Registry as the tool to support the mandate of NCR of monitor over-indebtedness, publish statistics, and understanding the performance of the credit industry, and with the granular information, develop analytical tools that will support the decision, policies, and macro and micro oversight, and all of the tools that will improve the process of both the public sector and the private sector. This topic was discussed at length in the previous phase with all the relevant actors. The laws were analyzed, participation of SARB, NCR, FSCA, and many others. And work streams and steering committees were created. The decision was taken to create the registry. There are several options. We have a session specifically on that. There was a diagnostic conducted that will be presented to you. And finally, during COVID, many credit and credit information authorities, central bank around the world made different decisions on what to do with the data that is reported to the Bureau during this time of crisis where people were losing jobs, where accounts were getting delinquent. Some stopped reporting, some did nothing, others stopped reporting only negative data. And the consequences of that at the moment might have been good to resolve an instant, but were not the best towards the future. Quality of data would be diminished, therefore scores would not be as predictive. So the ICCR developed guidelines to safeguard the integrity of the credit information system. We have been communicating and disseminating these guidelines. We did that here in South Africa. One of the recommendations, for example, is to use, instead of restrict the reporting, to adopt the use of technical codes to identify, in this case, COVID, but it could be used to identify any kind of crisis in a way that when a lender is consulting the Bureau and a subject has one of these codes, you can understand what were the circumstances for that individual or that business to maybe have been delinquent at some point, and you can make better decisions understanding those situations. So that was first one. In first two, the objectives, Lynette explained them very well. We want to continue promoting the extension of credit to MSMEs, the ones that do not have any kind of information, to boost those that have thin files with this alternative data, support business credit reporting, BISCRE, to incorporate all of these businesses, support the automation and capacity of NCR, and we have some special asks from NCR on some topics of interest. So it was 4 components before, now we have many. Some are extensions of what we started in phase 1, like the adoption of alternative data, more pilots. Please think of ways that you want to test. We are here to do that. We're going to work on together with all the stakeholders on the credit registry. Diagnostic has been done. We need to work on governance, procure a system, deploy the system, capacitate the people that is going to run it. BISCRE. Diagnostics have been made, a lot of them. Legal and regulatory arrangements have been analyzed of what is currently here. We again have to work on what is the governance framework, what data is the one that should be reported, working on templates. Do pilots before we launch anything and scale it. Let's test it and make sure that it works. Then I talked about NCR automation and the technology to be used for oversight. There is an interesting need coming from regulators of credit information systems regarding scores and other analytical tools. And we have started, actually in other countries, if it is important here, we will do as well, in evaluating the transparency of those analytical tools to give confidence to the regulator of what is the methodology that is being used, that it is really complying with the not only the regulation, but with best practices, and to give comfort also to the lenders that these tools are predictive, that they are going to provide them with the solutions that they need. Gender is very important for IFC. It is very important for South Africa in general. And we want to, I'm sure for SECO also, and we want to incorporate an exercise that we have started also from the ICCR. As you can see, ICCR is the basis of much of the work that we do. And here we also want to start with an assessment of the access for women, what data is particularly needed for them. And there is probably a different set of rules that may be needed to model the performance of women, because they have different kinds of activities and different demographics, different behaviors that may be needed to incorporate in scores, for example, to really assess them and allow them to get be part of the system. And the last point in terms of research, I think all of Africa should think about cross-border information sharing, because there are so many networks already in place. South Africa is interested in probably maybe also leading the work in this space. How to make NCR, the credit registry, sustainable? We are going to evaluate and benchmark against similar institutions in other parts of the world. And finally, climate. Climate is so relevant these days. I don't have to tell you all of the activities and innovations relating to climate. We want to also consider and analyze what is our role within credit information, the role of NCR in reporting climate financing. So this is my presentation for today to open the work, and we have a tea break unless you have questions for Lynette and Daniel. Thank you very much. So it's tea break, right? It was in the agenda. So somebody tells me what tea break is. It's just across the room. My little elves. Okay, let's take a break. Yes, you have a question? Can you get the mic? Let me get you the mic because I'm not jumping off here. But...
Hi, my name is Donnie Meyer. I'm from the Reserve Bank, and I work in the credit environment, but on the banking side. I just want to understand, I know that this is a big project, and there are lots and lots and lots of credit providers. So what is the NCR, do you have enough resources? Is that a constraint? Because I know that's going to be some of the issues that might come up in future. Thanks.
Absolutely. I think I just mentioned it now. In the whole exercise, that is one of the assessments that we have to do. We first have to understand what it is the end that we want, what kind of system. Is it going to be a system that is run by NCR together with SARB, or by a committee of several authorities, or is it going to start by getting information from the bureaus? But definitely an assessment of technology and human resources is at the top of the agenda for that. And thank you for, so I now invite you to participate in the exercise as well, because SARB is the regulator of the most important credit providers in the ecosystem. Anybody else? Yeah, go ahead. Somebody give the mic.
Good morning. My name is Michael from the Reserve Bank as well. I'm almost new in the area, so I might ask 11 questions. But I think linking from what Danny was asking, the Reserve Bank is going into a new cycle of a strategy. And I think the question that Danny asked is quite important for us to know, so that when you go into a strategy discussion, get a sense of how much of the Reserve Bank should be involved or will be involved. I think that will kind of inform. So I think if we can, even if it's not in this forum, but I think outside the forum, we kind of extract what will be the form and shape of how the Reserve Bank should be involved. And of course, we'll want to be involved, but I guess we must just kind of clear that. A couple of maybe questions that may come up later or maybe addressed later. So I think the one is, so I come from a statistics department. So I think part of my obsession is about quality of data, integrity and everything. And I think just get a sense of, in relation to the use of alternative data, what has been your insights, what is your level of, or at least, and again, it may come later, say, what is the level of comfort or quality of the data that is derived from alternative source of data. And the other point is around legislation, to say how integral is the kind of changes, if there are going to be any, in legislation ensure success. And then maybe you can also just talk to that. Thanks.
Thank you very much. So in terms of participation, I have 2 volunteers, I'm including you, but formally there is a steering committee, and it will be part, the starting point will be engaging especially SARB and other authorities that are relevant to the table to design together the best solution. On alternative data, unless you're planning to leave early, stay for the alternative data session. I think that itself will answer your questions. And in terms of regulation, we don't have the answer now. And that is why we're here with this project, with the participation of all the stakeholders, so that if there are gaps, if there are options of solutions that need to go into adjusting any regulation, then we will work on that together. Colin, do you want to add anything to this?
Thanks, Luz. I think you addressed most of the questions. On alternative data, I think you get the bureaus to tell you a bit more if you nudge them in terms of the actual statistics. We have Lee Naik from TransUnion, Yako from Experian. But what I can say broadly right now is that there's been a lot of work on alternative data across the globe. And there are 3 things that we know for sure. That it is predictive, depending on the type of data that you are looking at. Data will be different. There is data that is self-reported, which people would worry about its predictiveness, but there's data that you can quickly integrate and get from other credible sources like cash flow data and all of that. So I think that panel, which I'm moderating, will deal with that. In terms of legislation, we undertook a landscape study in 2021 on alternative data in South Africa. And what that study did was to surface what is prevalent in South Africa from an alternative data space And then we made a very conscious decision that we wanted to do pilots, take advantage of the innovation space, your sandbox and all of that, to be able to test the predictiveness before we convince legislators. Because in the past, we would start by saying, can you change the law? And it will be difficult. So now we are hoping that after testing, people can be able to be more convinced. We are, however, convinced that there is data that does not require legislation. Part of it requires just a bit of nudging, simply because the primary focus of POPIA is that, and any data protection regulations, is that data belongs to the data subjects, not whoever is the custodian of it. So if we were to just implement that and say, let me use a very sort of, I didn't want to say silly example. It's silly in the context that I'm picking at some people right now. My banking transaction data belongs to me. And in terms of the act, if I consent to give it to Janine, that data should be shared, right? So that does not require me to change any laws, but to implement the existing laws like POPIA and all of that. But it's a conversation that we are going to delve into deeper to address it, to say what part requires legislative changes, what part requires enforcement of existing legislation, and what part just requires people to persuade each other. Thanks.
Thank you, Colin. Anyone else? Yes, the mic here, please.
My name is Pumzile Chifungese. I'm from the National Planning Commission. I wanted to find out what has been and what is going to be the role of the private sector as well as DFIs. Is it going to be more of implementing the framework that is going to be developed as a result of the phase of the program, or are we planning on integrating them into these pilots to see what can be done and what will and will not work as compared to bringing them in at the last end of implementation? So just a little bit of a clarity on the role of private sector as well as DFIs, who are essentially responsible for closing that funding gap for SMEs.
So the pilots are conducted by the private sector. They're leading them. The regulator is there observing, understanding how things are working, what is needed. And like Colin just indicated, they will provide the evidence of what is needed to be adjusted, both in the private sector and in the public sector through regulations or any other maybe minor directive. So the collaboration is there. It's needed because the private sector is the one that has the tools. They are the ones that know the business. They are running the economy. We are here to facilitate. I'm talking for you. We are here to facilitate the process. IFC and whatever other DFIs are going to then support in making this happen. Colin, my twin.
So I think just to build on the role of DFIs, there's one, the enabling environment, which Luz has spoken about, but our other mandate is actually financing, and that financing is through private sector. So what we are looking at is on how we can be able to help in innovating, to be more specific, let's say on alternative data, to innovate in terms of increasing visibility, promoting innovative credit underwriting methodologies, but also at the back end of it, look at ways of supporting financial institutions through either debt or risk mitigation instruments like risk sharing facilities so that they will be able to take a bit more risk than they typically would accept because they perceive MSMEs to be more riskier than we think they are not. So we are trying to look at it across the credit value chain. Where are the friction points? How can we help in addressing them? And as an institution, offer a bundled solution that addresses that.
And just to emphasize, is credit or investment to the private sector. Anyone else? Thank you very much. We go to coffee. Are we having a photo session? My bosses? Maybe we should, since nobody wants to have tea. Carmen, Shangwane, can we get that organized? Do we do a quick photo session and then I need the photos. Second needs the photos. I want to send them photos. I want coffee. Let us speak with everybody. Oh, everybody. I know.
If I can't afford it, then I can't. Understand? I'm not going to start it. She seems like she. Ready? Six of those.
Because, so obviously you depends with someone's lead. They agree with their part. So the other said, I know we can't make them offices, but you can log on to the. It's a guy that does. City. He's a photographer. An hour of Monday. Right. Same that, but just we'll see. Monday. Let's come back tomorrow. Yeah. One for you, pay you money back on this Friday. A small job, but a small job like that, we give that much trouble. Yeah. All members. Yeah. Yeah. Job. Jen. They all of them. Some of the video, we're getting it done, you know? We had so many things to think about. Yeah. So, one of those things now, so see it as a big room. Yeah. And people saying this. Perhaps a good job. Supposed to be focused on it does other work as well. Yeah.
Sure, you can do this thing.
Yeah, see, there was this one job in the Emperor, it was peace science. This lady, see something like that. It's extremely, I think some kind of problem. And my son was extremely big. I was there. Troubleshooting the son's on his phone. Thinking, no, but no, wait. It's always not the problem. There is no, yeah, there's no, yeah. Your friends can wait. They'll still be there. They'll still be there. Get paid though. But yeah, so you could, and then, you know, even though in my son, we had this us job. My son, the rain over the breakaway, and he came back into recording. Same, check recordings. Fix it if you need it. Make sure you find the next day. Yeah. You didn't monitor, you made it. Fix it. And they send it to me. He did like, okay, yes, I understand. This is a preventative, because it's a preventative mistake. It's not like an unpreventable mistake. It's like there's no dogs and something. You can't do it. Yeah. But monitoring your points, you can do that. Yeah, yeah.
Yeah, that's true.
So, yeah. But I don't mind working with it. He's always like polite and quiet. He's good. He's good with clients. Let's take it's a guy named he works for ISIS. Yeah, it's so good. And he will just like unplug stuff. Oh,
So if we had close to it. Yeah, it was
Big Joe, I think it was.
not one of them. Another.
It was this massive thing you did, which so when we hit like on the road, stayed sound. I see one. I was thinking about this eight to 10 guys sitting in this area, managing stuff. And when, like, there's something wrong with the sound. Look at the sound guy. And he fixes it, then we all back in our station. Something goes wrong with the projector, everybody like, oh, the eighth guy. Are you getting it? Okay, it's fixed, okay.
Everybody's there.
Yeah, yeah. You're still waiting for the.
It's almost 2 months. I don't know what if one, but I think this one we do like So I'm expecting when it's coming tomorrow, I will ask him. So I think, the one for so it took that thing. That's Imagine pesos, imagine. Yeah.
Yes.
Hi, Luz. Yeah, it'd be nice to chat about what we plan to do next week. We're gonna meet, but I'm really interested in meeting your clients there because I think in South Africa we're doing some of the more advanced types of credit information work. So I'd be very interested to meet the client. So let me know. I'm on sick leave today, but I just needed to recover because I was feeling a little weak yesterday. I'm fine, Jared, but I wanted to rest, so I'm at home. But feel free to call anytime. Thank you.
Is there anybody join the?
I think there was a live streaming to the YouTube link.
Uh-huh.
We don't have access to.
Okay, I'll figure it out. Thank you.
It's wonderful.
Hmm?
Do you not think that we need to make a concrete announcement around a bigger group 41? Because I saw that they've been broken into many, but it'll be nice if we have one big photo of all the delegates in one place.
Yeah, that's what I thought we were going to have.
Yeah.
That is all.
So I think what we can do is before lunch.
Okay.
before
I'll
people-
ask some of the communications people to come,
Yeah,
give them the instructions precisely
Yes.
where they have to go.
yeah,
I will just tell them that they won't eat without the photo.
good. Thank you. Yeah.
So welcome back. Tupan, you're ready. I hope you enjoyed the tea break. I am going to try that photo again later, okay? Just please follow the instructions. Let's go into the first topic, alternative data. Tupan Magoleko, Executive Senior Legal Advisor of NCR, will share the NCR's journey, learning about the alternative data landscape in South Africa, the experience with the pilots, and what's next. What's next in their agenda, from thin files to thick profiles. Really like that title. Tupan.
Okay. All right. Yes, thank you. It's still morning. Good morning, ladies and gentlemen, and thank you, Luz, for that introduction. I think before I go into my presentation, I thought I should just give a little preamble of why the NCR is working on improving credit information reporting in South Africa. I think over the years, some of you would know that the focus of the NCR has always been to fight reckless lending and overcharging. So we'll be investigating credit providers for reckless lending and overcharging. I think our experience through that journey made us realize that perhaps our fight is not properly aligned, because at the core of reckless lending is data. What I mean by that is that we realized that in order for us to be impactful with our core mandate of combating reckless lending, we need to look at the data that credit providers rely on in order to assess for risk, but ultimately to ensure that they don't provide consumers with reckless lending. And this is why we are here today, to work with stakeholders to improve credit information reporting in South Africa. So going into my presenting on alternative data, I think the title of my presentation is From Thin Files to Thick Profiles, the Power of Alternative Data in Credit Reporting, i.e., how do we as the NCR transform consumers who do not have records at credit bureaus or who have limited records at credit bureaus to a state where they have information that credit providers can rely on in order to assess for risk, but ultimately at the core of our mandate to combat reckless lending. How I intend to take you through the journey that we embarked on in trying to, maybe trying is not the right word, in working towards transforming these consumers, and these consumers will also include SMMEs, from being thin filed to thick files. I will take you through the background, the rationale. I will talk a little bit about the leveraging of alternative data in South Africa and the approach we followed, the way forward, and conclusion. In terms of the journey itself, I think it's important to bring this back to the mandate of the NCR under the National Credit Act. One of the purposes of the National Credit Act is to promote the development of a credit market that is accessible to all South Africans, in particular the historically disadvantaged consumers. I think with historically disadvantaged consumers, it is clear that most of them are operating in the informal sector, whether they're employed in the informal sector or it's SMMEs that are operating informally. And by virtue of them operating in this informal sector, a lot of their data does not end up at the credit bureaus, which means that if they want to grow their businesses or access credit, whether it's for education or even for buying houses, they are not able to do so simply because the lack of credit is an impediment for access to credit or other financial services. So it is encouraging that actually at the core of this work, we're looking to transform the economy by bringing in those who have been excluded, particularly the Black communities and SMMEs, into the financial sector so that they can also meaningfully participate in our economy. And on this slide, I just have the statistics in terms of how financial exclusion looks like currently. A previous study by the IFC has estimated that around 5.8 million SMMEs in South Africa, 14% of those were in the formal sector, whereas 22 were in the informal sector. And by that, we already know that if they're operating in the informal sector, the data will not end up at the credit bureaus, which means they will not be able to access financial products. Some of you might not know that the NCR is actually a member of the International Committee on Credit Reporting, which is I think the IFC is the secretariat of that committee. And it was during an engagement under that committee that the NCR undertook to be engaged with alternative data for South Africa. And as a result of that undertaking, this was in 2018, I think it was at an engagement in Saudi Arabia. I think Luz can confirm for me. The NCR agreed that we will pilot projects that will enable the use of alternative data in South Africa. As a result of that undertaking, we then ultimately ended up with an agreement that I think my colleagues have already alluded to with the IFC, in terms of which we agreed to cooperate with one another on alternative data. And I think I have already mentioned the rationale for this project. It's twofold. We want to improve credit information reporting in South Africa, and we want to support financial inclusion. In terms of the approach that we have followed after the undertaking that we took to work on alternative data, two-pronged. Firstly, we commissioned a study with the support of the IFC to look at the alternative data landscape in South Africa. In other words, we wanted to identify the data points of alternative data in South Africa so that we can understand the landscape as a whole. So that study has been completed. And secondly, whilst undertaking the study, we realized that with the unique nature of alternative data, it might be important to pilot studies or tests to assess the predictive value of alternative data. I think with traditional data, it is easy to objectively assess how the data or the variables can inform credit risk assessment. Whereas with alternative data, because it's a new thing within the financial industry, we thought it is prudent that before we can work towards making sure that alternative data is shared within the ecosystem of our credit bureau ecosystem, that we test the predictive value. We were not only, maybe before I go to the test, the diagnostic study itself, as I have mentioned, we have completed that, and we have a report that has identified these data points, the sources, and we also have determined the regulatory and legal challenges as far as the sharing of alternative data. And there has been recommendations from that study. The study was concluded in 2021 around the COVID lockdown. The recommendations that came out of the study itself is that firstly, we need to have a framework that enable business credit information for SMMEs. That was the first recommendation that came out of the study. And I think this recommendation links back to the BizCRE project that we will hear about later today. Secondly, the recommendation spoke of incorporating specific sources of data. There are data sets that we believe are ready to be shared within the ecosystem. So the recommendation has identified those data sources. Thirdly, we need to enhance access and the adoption of digital payment solutions into the whole ecosystem. So one of the important data set that has been elevated or highlighted in the report is data that comes from payment solutions. And lastly, I think the report also recommended supporting data sharing models that are led by business owners and consumer protection. So those were the 4 recommendations that came out of the landscape study itself. In terms of, as I have mentioned, our approach was two-pronged. We wanted to identify the data sources, but at the same time, we wanted to conduct pilot tests to assess the predictive value of alternative data. And we will hear later today from the two pilot tests that we supported. But the objective for the NCR in terms of supporting the test was that we wanted firstly to ensure that we can confirm that there is predictive value behind alternative data. So that was the first objective of the test. Secondly, I think it was mentioned in one of the questions, I think alternative data by itself comes with risks. So through the test, we're hoping we will be able to identify the risks that can be introduced to the consumer credit market or the financial sector as a whole, but particularly for consumers, so that as the NCR, we can work on ways to mitigate those risks. Some of the risks that I think have been mentioned is potentially discriminatory outcomes that may come from alternative data. So as we conduct all these tests, our aim ultimately, because our role is for consumer protection, we want to identify risks. I think globally it has already been identified that alternative data has economic value and can unlock opportunities. But for South Africa, particularly and our local economic climate, we want to ensure that we accurately identify all the risks and we put measures in place to mitigate those risks. So we will hear later about those two pilot projects. Where to from here in terms of how we're proceeding in phase 2 with alternative data, we want to continue to test the various sets of alternative data for the same reasons that I've already mentioned. We want to assess the predictive value of alternative data, and we want to accurately assess the risks, because I think for us that is at the core of our mandate, to identify risks so that we can advance consumer protection. In terms of that, we will also, once the risks have been identified, we anticipate that there might be a need for regulatory reform, because the only way we believe we will be able to implement controls to protect consumers against the use of alternative data is through regulatory reform. And I have also mentioned that through the diagnostic study, we have already identified, or the study has identified certain data sets that are ready to go into the mainstream ecosystem so that we can improve the quality and the quantity of data in South Africa through the use of alternative data. In conclusion, yes, the NCR has taken a lead to advance the use of alternative data in South Africa, but unlike traditional data, especially in the credit space, the source will usually be our credit providers. So we're able to alone regulate that space in terms of how the data should be shared. And we have already done that through Regulation 1913. But alternative data by its nature sits across various industries. So we believe that if we want to ensure that the use of alternative data will be successful, we need collaboration with everyone within the whole ecosystem, the financial sector, the other financial sector regulators, to ensure that the sharing of this data can happen and be successful, and ultimately we can achieve the objectives of the NCR being to improve credit information sharing, but ultimately consumer protection. But for the other regulators, it will also be for financial inclusion. Thank you.
Thank you, Tupang. Thank you very much.
Thank you.
So like Tupang indicated, there are 2 pilots. We're going to invite now the lead of the pilot led by TransUnion, Lee. Lee Naik, the CEO of TransUnion Africa.
Okay. Sorry, I'm too tall. Good morning, everyone, and thank you to the NCR, the IFC, and all the other key stakeholders that made this presentation possible. This is just one of two pilots you're hearing about today, and I think it's probably worth saying that any pilot that demonstrates the value of all data in solving a problem is good for our entire industry and our economy. So we're grateful for the opportunity to be part of this presentation. So I will talk a little bit about financial inclusion, and it's not just about the pilot, but I think it's also important, given the variety of stakeholders, to almost catch up on some of the key lessons learned in getting to where we are today. So sometimes we don't understand what the simple word means. And I was actually looking back, Liz, at the definition from the World Bank. We talk about financial inclusion being the ability to give access to a financial product or a service to every person on this earth. In the African continent, there are 500 million people that don't have access to financial inclusion. They may have access to a store of money. Like my dad, we've come from Chatsworth in Durban. He still keeps his money hidden in places around the house. It doesn't attract interest. There's no leverage there. And there's something to be said about why we don't and can't access financial inclusion. So the problem at an African level is some 500 million people. But financial inclusion has stopped just being about accessing a store of wallet. For example, you've heard more and more about the role of telcos, and then Tupang gave mention of that as well. In a place like Rwanda, which has just declared most recently that the financial inclusion is up to 99% of their population. The question is, what does it mean? It means that more people are getting access to mobile telephony and using that as a store of money. So in the case of Rwanda, that store of money sits in a platform called Momo, and that wallet allows you to start the journey of financial inclusion. So per the definition of the World Bank, inclusion starts with accessing a store of money, but then has to progress from having a chance to store your money, to be able to save money, to transact on money, then to create leverage. That final component, when I can start to leverage credit or gear with credit to do something, I can then start to borrow money, to buy my fruit, to man my store, and pay it back by the end of the day. In a place like Kenya, microloans go as far as 6 million microloans a day, and that's just with one credit provider. So as you think about the evolution of inclusion, it's not just about giving us access to the banking or the lending economy. It's about advancing the nuances of inclusion for the situation we find ourselves in. Not every one of the 60-odd million people in South Africa needs the same kind of finance that you need. Not everybody wants to buy a house or a car. Somebody wants to start their journey to open up that spaza shop, to lend a room in the back of their house. That journey starts there. So it's important to contextualize what this means. So when you talk about this problem we have, which I've articulated, it actually has a lot more color, right? So not to be depressing, but it's important to understand the problem we're solving. So just in Q2, the unemployment number has actually gone up. I'm not sure you follow that. It's gone up from 32.9 to now 33.5. So we know it's become more challenging in South Africa. With all the positivity I can portray today, it's important to recognize that the burning platform starts at recognizing that unemployment is high on a reported basis. If I then include discouraged people that don't want to participate in the economy, it's close on 45%. So there's a fair bit of negativity there. In South Africa, if I think about the number of people living in extreme poverty using a World Bank definition, that number is 18.2 million people. How do you juxtapose that definition? The World Bank and other bodies like the UN talk about the national poverty line. The national poverty line in South Africa is around 760 rands. That's how much you need to have the minimum nutrition to live your life. If you collect one of the grants from government, which is either the one we had post the pandemic and pre the pandemic, we have 29 million people that have access to these welfare grants. They used to be around 350 rands. So even if you got 350 rands, it's not enough to meet the requirements to live a healthy life. That's the challenge we face today. So when we are asked to participate in a pilot like this, the question is, what is the outcome? The outcome is not for us to talk about the report back. It's to actually say, how do you move from this being a problem to the opportunity of solving something that creates a growth in the economy? There is positivity. The positivity is the fact that Africa as a continental region is outgrowing every other continental region globally. By 1%, our GDP will grow faster than any other part of the geographic landscape globally. Now, we're a small part of the world's $105 trillion economy, but there's a lot that needs to be done. So that context is super important. Why are we here? Not just for the reports. If we get this right, we're starting to talk about every adult in South Africa that can't access finances, starting to make the movement from store of wallet into leverage, which is key to not just inclusion, but to the growth of the economy. So, you know, it's interesting. I joined this business called TransUnion back in 2017, and everybody said to me, it's your grandfather's credit bureau, because it started in 1901. You know, I wasn't around back then, but Liz tells me it was really cool back then. It's a joke, Liz.
Perfect.
It was perfect. And back then, things were different. But over the last 40 years in South Africa, the way credit has worked has been largely the same. So when you talk about a conversation like this, it actually is against everything we know about how credit works. So for us to be thinking about credit bureaus, if you think of your first memory of a credit bureau, it's probably, hey, Lee, can I catch you in the lunch break? You guys said no to me, right? It's a no or yes decision. It wasn't about, I have a dream to, you know, pay for my lobola, to buy my house, to buy products for my stand. It wasn't about that. So we need to find a way to overcome this history of being this grandfather's credit bureau that said no. But a lot has changed over, you know, the last few years. I've been there for 7.5 years. Things have changed. The biggest change that I've seen that we've led in our organization, at least, is the move from seeing a score to seeing a story. Now, this is a huge part of what myself and the speakers after me will talk about. A score is at a point in time, are you good or are you bad? It isn't about, I've lived a hard life and I'm becoming better. Don't you see what I've done? It says, I'm judging you today. It's what we call point in time decisioning. However, if you start to hear my hopes and my dreams, and you start to realize that Lee is more than just a score, this is what he hopes to achieve. And I've got this amazing idea, like a Ludwig Marischane that came up with Dry Bath years ago, but could never commercialize this idea because we couldn't see the hope of a young kid from Limpopo that wanted to solve a water shortage problem, right? The question is, how do you see that story? And so when you think about scores like Ntupang and all our speakers before us have spoken about, it's more than just a number. It's, can you find a way to help me see my dreams? Now, it's interesting when you talk about scores and consumers, because if you look at South Africa right now, things are pretty tough. Now, we've had electricity staying up, Liz, for over 120 days, and that's really good news. But that's only the start. The economists start to say that just by keeping the power on until the end of the year may put us on track to have GDP growth closer to 2%. But that's well off the other leading economies in Africa. So some work must be done. The problem with South Africa, though, is that our consumers are highly indebted. Think of your cousins, think of your family. We can't afford to pay for our basic needs because salaries aren't going up aligned to inflation. Fuel is going up, the food basket price is going up. So how do you start to figure out how to solve the problem? Now, if we are looking as the private sector specifically on creating more growth for banks and lenders, it's actually difficult because there aren't enough good consumers out there. And I hope that point lands. If you're looking for good customers, it's actually quite tough. If you ask Ntupang and our folks at the NCR, they will tell you that the credit bureaus can see about 27.4 million credit consumers. That means in the adult group of some 40 million people, we can't see 13 million. So now think about my 500 million number across the continent. There's 13 million that in theory want to be part of this economy, but we aren't necessarily seeing them. So what's the problem statement? There's about 13 to 15 million adults that want to participate in theory. Can you see them for more than the score? Can you see them for their story? And here's what's really interesting. We're only 30 years into our democracy, and the alpha gens, my kids are 14 and 16, they exhibit the similar behavior to those that were historically disenfranchised through apartheid. For example, kids don't want cars. They don't want houses, right? They want to not work, right? They want to earn just enough to afford a balanced lifestyle, very different to us in the room. The behaviors of the millennials, the Gen Zs, the alphas, exhibit very similar attributes to those that were historically disenfranchised, where they came from a township economy and had a job as a vendor, as a street flower vendor, for example. So those 13 to 15 million people are the ones that want access, but we as an industry don't necessarily want to give them access because they don't have the same behaviors as the 27.4 million people we've known for a long time. So why are we then talking about businesses today? Throughout the COVID pandemic, almost every government around the world said we've got to save MSMEs. But why MSMEs? In Daniel's presentation earlier, he spoke about 50% of employment comes from MSMEs. And the research I've done, it's closer to 70% on the African continent. So why is it important? If I had 50 people this year as TransUnion, which I intend doing, it isn't going to move the needle on unemployment. There are millions of people unemployed, people that are discouraged from participating in the economy. So what do we do differently? We're going to find a way to drive a focus on businesses. You're going to hear today the concept of BizCree, and I'm super pleased that it's become a mainstream topic because we've been at this for over a decade as an industry. If we start to hone in on businesses, you're doing a couple of things. One, you're realizing that those that are unemployed on the consumer side of the economy, they want to participate. Not that they don't want to, they want to. There's no opportunities. If we focus as a lending industry on finding a way to hone in on businesses and enable them to actually have access to finances, to see their potential, to see their story, then suddenly they could create jobs. How many jobs? Every MSME has the potential to create between 1 and 5 jobs. Then you start to think about Luz's number. There's 5 million odd MSMEs, depending on who you talk to. If it's CIPC and DTIC versus the informal economy. Let's say there's 5 million. If they start to create 1 to 5 jobs, unemployment is gone within a decade or so. So when you think of why we're here, why this pilot's important, it isn't just because something called scores. It isn't about the score. It's about the story of growth for the economy. So businesses are important. The question is, so where does this leave us? So when we thought about this specific pilot, we had to think about our experiences working for over 100 years in South Africa and what would have to change. And here's what's interesting. We spoke to thousands of consumers that we have on our customer base. The challenge was that nobody was as excited as we were initially. So when you think about the approach we had to follow, we had to come up with a different approach. And you'll hear different approaches from the other pilots today as well. Because we've been around for a long time, we have what we call the rails. We exist, we connected already, but could a new conversation start? So the first question was, we have data as bureaus that are highly commoditized and industrialized. We all get that data. But that data got us to 27.4. It doesn't talk to the 13 million that are excluded necessarily. The first question is, how will we find sources of data that actually allow us to be included? Michael from the Reserve Bank asked the question, tell me about the quality of the data. So Michael, for us to infer a decision on extending credit under the NCA, we need to be responsible, not just as credit bureaus, but as the industry in making the right decision. The first part of our approach was, how do we identify sources of data? And we shared this with the NCR at the very outset when we started phase 1. These are the kind of targeted data sets. Who do we think we can get them from? And then when we found who we can get them from, can we confirm that it is industrialized, it is trustworthy, it is actually of the right consistency and reputation? Those are the things we thought about at the very first point. The second thing to note is that South Africa is quite an advanced credit bureau market. Luz mentioned it has one of the biggest number of credit bureaus in the world, but South Africa has actually informed many markets and how their credit works, whether it's India or Hong Kong or many markets around the world. South Africa has had a key role to play. So when you think about the use of scores, Scores has been in South Africa for decades. It's not a new thing, it's actually an old thing. So when we thought about how we'd actually approach the pilot, we did it a bit differently. As opposed to finding a net new way to do the pilot, we asked ourselves, okay, we have thousands of consumers or customers that work with us as businesses. How can we find a way to identify new data sets that are within the realm of who we work with, as opposed to finding net new things? You know, people would say, why can't you use Facebook data or other social media data? Those don't tick the boxes, Michael, of trustworthiness, you know, the reputation, the timeliness of data we need, the ability to protect its reputation over a period of time. So we identify data sets. We then said to ourselves, many people are using scores today. Can we move from using a traditional score of traditional data? Who would be open to working with us in a new way of scoring? And you call these alternative scores, as both Ntupang and Luza said. We actually started as TransUnion with our first alt scores back in Feb of 2018. In Feb of 2018, I went on to CNBC Africa and said, for the first time, we can see glimpses of 2.8 million people that we couldn't see, right? It started back in 2018. So our pilot kind of goes way back. We had an initial sample view, as you'd say, when you build scores, but over this period of time, we started to get people to buy into it. Now, here's where it's difficult. Even if you have the answer, we found that people didn't believe us. Lynette, for a first client that bought into alt scores, who's now a big user of it, took us 9 months to go through every committee before they said, yes, let's try it out. So even if you have the answer, right, the industry at a business level isn't sophisticated enough to say, that's interesting. What's the consequence of doing this? Am I in trouble? The benefits of this pilot under the NCR is that the NCR said very clearly, if you participate in this, right, you get a sanction to try this out without that downstream consequence. So we then started to find businesses to work with us that were super interested. So in our approach, score expansion versus starting from scratch, because if you've known scores, it's not a big leap to go from I've used scores to what are the scores I could use that are in the alt space that are trustworthy. The other thing to know is if you can get one big player in an industry to say yes, their competitors follow suit as well. So finding a pro pilot participant was a key part over the last 5 years in getting us to move the pilot forward. And I will show you some numbers in a second or two. The third thing is the word distribution. You're going to hear this many times over. I've been listening, National Planning Commission, SARB, IFC. This is super exciting for me as a private sector person. Actually, we haven't seen each other for years, so some of us are taller, thinner than you thought compared to the Zoom calls, but now we're here. But more importantly, if we can collaborate as private sector, public sector, international donors, there's a lot more we can do here. The word distribution also represents the word partnerships, right? There's nothing we can do by ourselves as the private sector. In fact, if we could find a way to come together, we could accelerate the progress we've made. I'll show you in a second what we've achieved. But if we could talk about distribution, the big takeaway, and I'll come to this at the very end, is if we partnered better, we can scale. South Africa is notoriously bad at partnering. It's easier for me to go to other businesses in Kenya or Rwanda where let's partner, it's not a problem. We are still compartmentalized. We want to keep it within the walls. If we realize that we break down these walls, the economy wins. We win as civil society as well. So that's super important to realize. This is the approach we took as TransUnion. So to talk about this approach, there's two concepts that we leveraged. One you've heard about today called alternative data. We've all know the word. The second thing is that if you don't know the word, it's super important to learn this phrase. It's trended data. So trended data allows us to infer things about behavior, not just all data. In combination, it allows us to understand that Lee was bad. He's still bad today, but he's becoming good. And you can model how long Lee will take at his current trajectory for becoming good. Lee is bad, but in 3.2 months, he's going to be good. That's interesting to know. And if you can prove that using actuarial models and actually test how you provide a risk against it, it's super interesting. So when we approached the pilot, we brought together two concepts, alt data and trended data. Now, the benefit of working in a global organization is that these concepts were tested in places like India, Brazil, Colombia, in that emerging market set. So we had the theory that says, if it worked there, it should work here. How do you prove it out? We took 3 lenses on our data. We wanted to have a lens on consumer. And as I said to you, we started the consumer lens with alt data scoring back in 2018. We then moved into formal businesses in the mid phase. And then when we started this pilot in 2021, we doubled down in the informal business sector, all the way from MSMEs to microfinanciers that form part of the MFSA. So when you think about this category of people, the question is, what can you do? So I'm going to give you some flyby stats. The nature of this conference doesn't allow me to go into deep detail, but I want to tell you that for each of these areas, we were able to identify data sets that are available today, right? And I like what Ntupang said. Ntupang said they've identified data sets. They want to promote standardized access to it. Now, for all the pilot participants and more, we know that if we had sustained access to this data, we could drive value in the short term. Right now, in the few years we've been doing this, it's been a battle to access the data sets that surround consumer. But there's certain data that we will show the NCR through the pilots, actually high value targets for standardized access. It's not the use that's the problem. The use we've proven works. It's the industrialized access that we struggle with as the industry that works with scoring. So what did we find? This is super interesting. If you don't know the taxonomy of how we talk about this, we talk about inquiries, right? So when you as a business as a person goes into a bank, you want to get access to finance. So on the top left-hand corner, in the year 2023, for obvious reasons, I'm not showing you real numbers, and I'm also not even showing you how many of these participants are. But in the consumer segment, lending to consumers, we opted in banks, retailers, telcos, and insurers, and auto financiers. Many, not just 1 or 2. So it's taken us a long journey, but we sped up as we got to the end of the pilot last year. By the time we got to comparing 2023 with 2022, by leveraging alternative scores, we saw an increase of 165% in inquiries. So what does it mean? It means that when you get to the front door of want to access finance as a consumer, could be a personal loan, could be a loan, could be a car loan, previously it would have been said no to. They couldn't see you because the method of decisioning disenfranchised you. For the first time, by using alt scores lids, we saw a 165% increase for these named participants, thousands of customers or businesses we work with, but for these that participated, 165% increase in inquiries coming to the front door. An inquiry means, from a marketing perspective, I can see you, then I can then apply further things, risk strategies, assessments, credit scores, looking at other data and making a decision. But if you couldn't be seen at the outset, you had no chance downstream. So you got through the front door, at the teller or the guy with the forms, whereas previously you didn't actually get through the door at all. They turned you away, said, we're closed for business. So that's a powerful thing that says, for the 13-odd million people that are disenfranchised, and for the 27.4 that are in the system, they can start to see something more about you. So when we talk about alt scores, you've got to think of it in 2 ways. Can I score more people that are disenfranchised? And can I score better? So with new data sets, can I infer something more about Lee? So if I'm a first-time borrower, you may give me prime +5, prime +2. If I want to get prime or prime minus, I could have other data sets that infer that. We applied that strategy in the consumer space with high success. Of course, what I can't show you today is how they performed, right, in terms of their actual performance as a credit user. What I can say to you at a technical level, it performs at the same or better as traditional scores. So that's really good news. Of course, with the NCR, we'll share a bit more detail as a registrant under the NCR, but it's important to know that for the first time, we could see new consumers being seen that couldn't be seen before. From a business's perspective, so I'm talking about commercial banks, commercial lenders, the types that belong there, telcos that are focusing on enterprise lending, insurers that do commercial lending. in a very similar way, we saw a 160% increase. So you look at all these adverts on TV for business insurance, people that would never get access to it, suddenly we had access being made available. So larger businesses going into medium was proven that all scores work. And that's why we're here today. Can you prove across the continuum of lending that it works? But that isn't why Daniel and Luz and Lynette have spoken about today's event. We really want to talk about this bottom section. Informal businesses and sole props. Informal businesses, per Luz's definition, probably is in the region of 5 odd million businesses. If I include the informal economy, that's worth 750 billion rands. If you look at Carcinomics and how Gigi Alcock talks about it, question is, what can we do there? So working with retailers, BNPL providers, microlenders, microfinanciers, we saw an increase of 135%. So for us, it's super interesting. Last year, I'll give you an actual number. Last year, for the first time, we could see 162,000 SMMEs that have never been seen in 2022. And that's a powerful statement. Relative to 5 odd million people, you are seeing SMMEs that could not be seen by the lending economy. So that's one good stat to take, which I'm willing to share. 162,000 MSMEs were seen by lenders that would typically turn you away. And it's not just about the decision. You know, if you are, as an MSME, going to the bank for a loan, it almost starts with distrust, right? Man, I don't know you. I need this amount of paper. What we're able to do is not just change the score, but change the pattern. So as opposed to giving me reams and reams of paper, could I tell you it's a yes, subject to you give me the paper, as opposed to give me the paper and 6 months later, after my cash flows run out and I have ceased to exist as a business, then you say to me no. So I'd rather know in a quicker period of time. And for one of our big clients in the space working on informal businesses, they can make a decision in minutes as opposed to days and weeks. So we're quite pleased with how the digital transformation, which is key to financial inclusion, showed up in this segment. So once again, we're able to prove out in the microfinance, in the informal business space, that all scores, unregulated data that meets the quality and industrialization requirements actually showed up super well in this area. So to wrap up, my final slide, I'm going to tell you all as participants what we learned, and I hope that for the SARB, the IFC, the National Planning Commission, anyone that's able to influence the support of all scores, what did we learn? We learned first that the use of all scores, it's a given. All scores will make a difference to financial inclusion. What Ntupang said, I'm super pleased to hear this, is that access to all data is going to become easier. I hope Ntupang and Luz and Lynette, it won't be only in 2027, still 2024. I'm hoping we start to progress that. So access is a problem. And it's not just the fact that people don't want to give it. The trust is not there yet. It requires education. It requires more roadshows like to educate the sectors. The key associations need to know that this pilot has been successful, and we're able to show them and convince them that they want to be part of this economy. And if you are wanting to be part of this, how can regulation support having industrialized access? That's the word. Industrialized access to a set of all data that will make the lives of the lending economy easier. That's the first thing. Secondly, partnerships are everything. I've mentioned this at the beginning. It was proven very, very clearly. If you think you can build it and you have all the capex to save South Africa, to save the world, it's not true. We're going to have to partner. We call this the sharing economy. There are things that you are really good at that I'm really bad at as TransUnion, and vice versa. If we came together, what is possible? You may find that distribution, meaning access to the consumer via their own digital channels, via existing products that you can complement, may allow us to support financial inclusion. So we learned that partnerships are key. You would have heard most recently that 2 of the big bureaus in South Africa have actually signed up to do a pilot with a big telco to actually test out how we can work with them to get to every South African, right? So it is possible if we break down the walls that prevent partnership. The third thing is speed to value. In the MSME sector, you know, MSMEs live day by day. right? The loans they want are not for a month or for a year. Some days they want $5 or $1 just for the day. They borrow the money in the morning and give it to you back in the evening. We aren't there yet as South Africa. We need to learn from the broader African community. Luz and Colin and many folk that visit will tell you that microloans are now becoming staple, just enough to make the day, to make the week. How do we start to see that? And if you really want to support MSMEs, the slowness of how we work as the private sector has to change. There's something we've got to do to become more faster as an industry, to be relevant to a group of people that aren't as sophisticated as us. They're living day by day, week by week. And I want us to be able to see that as an industry. And finally, it all seemed impossible, right? But I think the pilot has shown us, at least in our view, that is definitely what has worked in other markets like India, Brazil, Colombia. We've been able to show in a very limited pilot that it seemed impossible, but now we have proven that alt data and alt scoring can in fact support financial inclusion. Thank you for the opportunity to present our findings today.
Thank you, Lee. You must be proud and your team also of the achievements, and we look forward for the next phase. So we said we had 2 pilots. We invite Darlene Mencia, CEO of FinFine, and Mariette Ixner, CEO of Royal Finance, to share the Cool Alternative Data Pilot.
Don't know how we're going to manage this mic between us, Mariette. The tall and the short of it. Hello, everyone, and thank you for the opportunity to come and present our case study, our alternative data pilot to you. Mariette and I are going to present in team, and through some of the slides, we'll tell you a little bit more about ourselves. But this is a partnership between FinFine and Royal Finance, and you got the clicker. Let me hold on to that, thanks. The project is called Cooler, and what we're looking at is businesses that turn over less than R1 million in informal areas and townships, and how we get microloans to them. So this wasn't a pilot in theory or sort of quoting broad stats. This was actually a pilot working with those businesses, using our own money as 2 SMEs, creating scores from knowledge over many years, working at the base of the pyramid. So what Cooler does is that we provide microloans to enterprises in informal areas using mobile phones and alternative credit scores that we have created. So a little bit about ourselves, because we're not big names like some in the audience here, so might want to understand a bit about who we are. Mariette is the chairperson of the board of the Microfinance Association of South Africa. She works in her family business. Vice chairperson. I've just promoted her. She works in her family business that's been going for 30 years, and they have dispersed 2.5 billion over the last 30 years to over 1 million consumers in short-term lending at the base of the pyramid. So she understands this market very well. Myself, I'm the founder of FinFind, and FinFind is South Africa's leading online platform for gathering data from formal businesses, so most of those that are turning over R1 million. We've got about 1.3 million users in our base, and we manage the CIFA and other government loan platforms for collecting data digitally. Our bios are there, but that is essentially who we are. So what we want to have a look at is, where did it all begin for this product that we developed called Cooler? So we quote some stats back to the NCR themselves of saying in 2016 that access to micro enterprise credit could have saved over 750,000 SMEs in 2016, and that every 1% increase in access to finance could ensure 25,000 jobs were created by SMMEs. We're some years on now, but we know that in terms of micro enterprises and credit to them, it's generally a failure in South Africa. banks, MFIs, and cooperative banks have recorded failed attempts to try and service this vital market. Yet in other countries, micro enterprise credit has proven to be a sustainable, successful manner to develop positive social impact. So what is the struggle in South Africa with acquiring microcredit? This pilot actually dealt specifically with that, and we're going to unpack the learnings as well as some recommendations. But one of the primary problems we have in South Africa compared to other countries in Africa is the challenge of the digital repayments because of the cash economy. So costs are high, and solutions like mobile money, although they're affordable and easier, are not that pervasive. So you look at some of these other stats that are quoted in Kenya and other countries where mobile money is pervasive, and it's the normal means of transfer of money. That isn't the case in South Africa. So it makes lending to micro enterprises that are traders and how they're able to repay you very difficult, and those costs are high. We'll talk about some of that. If you look at an ATM deposit, it's 50 Rand. Now, if your repayment is very small, it can become the same or actually a large percentage of your repayment. I'm going to hand over to Mariette soon just to go over the actual pilot statistics themselves, but just to say who Kula is, what we do. So we're a partnership between two SMEs in South Africa who work in this particular environment. We provide developmental loans to informal or formal micro enterprises with a turnover of less than $1 million. I've been quite interested in working in FinFund and working in the alternative space and data for SMEs for many, many years, to notice that often people look at the market as, are you formal or are you informal? And in actual fact, that's not really the way that we see the market on the ground. Really, it's related to turnover. Some businesses are formalized in terms of maybe being registered as a business, but not turning over as much as someone who's not registered. So what we have a look at is formal and informal businesses that turn over between 48,000 a year and $1 million a year. That is actually the market, and I'm going to show it to you in a little bit more detail. The way that we worked is that no business registrations or bank accounts were needed. If they had them, that was great, but they weren't needed, and no formal record keeping was needed. So in this market that we're looking at, oftentimes we're looking at where's the formal evidence of sales or what you're doing with your money. But actually, if you speak to the entrepreneur, they know exactly how much, what the sales they're doing, what they're spending their money on, what their stock is costing them. And so this is the area that we worked in. All the entrepreneurs applied for loans using their mobile phone. So that was one of the criteria, and Mariette will go through that in more detail. So the whole process was digital in terms of the applying for the loan. The scoring was automated, and we'll talk a little bit about our scoring process. And to support the users was virtual. So we could work with entrepreneurs sitting far away in an informal settlement, and actually that had no other credit score, and actually rate them based on the score that we had put together from working in that particular market, and get the repayment. And we'll talk about how things went. So lastly, Kula combines traditional data, alternative data, and a social score that we've put together to develop alternative scoring for credit decision making. And I think the proof's always in the pudding. If you're going to put your hand in your own pocket, take out 500,000 Rand and say, we're going to test our scoring methodology on those businesses, then that, I think, we're not using a donor's money or coming to anybody here. We're saying we so believe in the turnaround that this market can do, that we'll take our own money based on our experience and do that. So lastly, if we just look at our target market, we are right there in the blue. Turnover of less than $1 million, as I've said, formal and informal enterprises, lending to individuals. It's not group lending like you would find maybe with MFIs. The owner and the entity are synonymous. They do not need to keep formal records. The income can include cash, and I think this is where it's become difficult in terms of being able to credit score when in a cash economy. The business and personal transactions can go through the same bank account if they do have a bank account. This is the underserved target market, and this is the market that Kula looked at. Mariette, besides being incredibly clever, is also an amazing photographer, and these are actual photos of the entrepreneurs that we lent money to, and she took those herself. So I'm going to hand over to her now.
Thank you, Darlene. When you said, we don't have the big names and CVs of some of these people, you were not speaking of yourself. I'm sure about that. I don't know if anyone has read her full bio, but I'm very privileged to be here and that she contacted me to be a part of this pilot. And just a little bit about myself. I was part of the IEDP in 2018. There's a few people here that's currently doing the IEDP, and they're going to Kenya and went to Amsterdam, and I'm quite jealous because I know when we went to Ghana, Tanzania, and Brazil, it was such an enlightening experience, and I think that is where the dream for Kula was really born, was going to these countries and seeing that it is possible to do microfinance to micro entrepreneurs. It is possible. It can be done. In South Africa, it's historically been very difficult. And I think the reason why Darlene probably called me, because I'm not sure, Darlene, we'll get the verdict afterwards of, am I either naive, stupid, or brave enough to try it? So I think the verdict is still out on that, but I think the pilot will prove it wasn't stupid. It was, I think a little bit brave. Let's go with brave. So the pilot started in April 2022. Before that, we did have last quarter of 2021, where we developed our product, our system, and all of that. But then we started doing loans on the 1st of April 2022. The pilot was in Kwamhlanga, Mpumalanga mostly. Oh, I'm not moving.
I'll move you.
Thank you. It was in Kwamhlanga, Mpumalanga, most of the loans. We did do loans, some in Bloemfontein, some in Klerksdorp, some in Mabopane, but mostly in Kwamhlanga. And that's a very rural and informal settlement. Then the duration was set up to be a 12-month pilot, but we did reduce it to 8 months because of the ongoing load shedding. The capital ring-fenced, Darlene already said, we put 500,000 aside for this. In the end, we did a total number of 90 loans to a total number of loan recipients of 54. The number of repeat loans was 36. So that was quite a good thing for us to see. They take a loan, they repay well, and then they take another loan and they grow their business each time with every loan. And then the total capital dispersed in the end was 575,000. So when you want to start a project like this, obviously you need some minimum requirements. So these are the minimum requirements that was set out from the start, and that was that the owner must be a sole owner of the business. They must own their business premises or their home. It must be a fixed business location. The business age should have been at least 3 years. They should have had 6 references at least. So 3 was personal references and then 3 business references. People that, businesses around them that know them well.
Just explain how you did that you contacted those businesses.
Yes, we contacted those references, obviously, and we asked them certain questions and collaborated that the story of this business has been here for so long, checked out. Then the business, okay, so they had to have a smartphone and they had to have WhatsApp because that was what we discovered, the preferred communication method, and that worked for us as well as for them. No formal registration or bank accounts was needed, and they had to have some form of record keeping. So we didn't require financial statements or anything. It didn't even have to be on an Excel sheet, but they had to at least have some form of, I'm writing down how much did I sell today, or here's some slips of some of the stock I bought or something like that. When it came to the loan product setup, we set it up to be loan amounts between 2,000 and 15,000 with weekly, fortnightly and monthly repayment frequencies, maximum installments of 1,150 Rand per week, and the loan had to be used to buy an asset or stock. So That was the setup. Lee just spoke of Carsinomics and Gigi Alcock, and I think everyone in the room knows him. We referenced Carsinomics to get an idea of the different business sectors and subsectors, and these were the ones that we were looking at. You know, we didn't know which of these sectors were going to apply for credit most, which are going to repay you the best, or anything from the start. We were just like, okay, these are the different sectors, and we are going to have a look at those. In the end, I'm going to talk now about the statistics of the applications and approvals and so on, but this is just a quick snapshot for you guys, and this is where I really get excited, is about the people behind the story. You know, Lee spoke about it's not only a score, it's a story. And I got my boots dirty, and I went out in the beginning myself to find the first businesses that we are going to start the pilot with. And they still call me, they'll probably call me today in the meeting as well, you know, and ask for their next loan. But so the first picture, top left, is Portia and Opa, and they have a takeaway store. And then the second one is Simon, and he's Portia and Opa obviously bought stock for their takeaway food store. They grew their business very fast, because they told me in the beginning, the problem is they have stock for a day, maybe 3 at most, and then they need to travel far to go and fetch more stock again. So every time they need to travel, it's costing them money, and they are going far for their stock because that is where it is the cheapest to buy. So as soon as we could give them money to buy stock for 2 weeks at a time, all of a sudden the game changed for them, because it was never the problem if they're going to sell the food. There was enough customers, they just didn't have enough stock. So that's their story. Then Simon, he bought a generator for his panel beating shop, and we all know why he did that. I don't need to go into why. Then Betty, she also bought stock. She bakes. She gets up at 2 in the morning, and then she bakes scones and vetkoek to go and sell at the Patco buses in the morning. And yeah, she's such a sweetie pie, and she is by far the best payer. So she pays early, okay, every time. So that the money also helped her, obviously, the same story as for Opa and Portia. Then Mandla, he had a business. His business started as, how I found him, selling ready-made food out of big pots out of the back of his Polo. So I know the word Polo, Magauta taught me that it's not a good name word. But for us, it's just a car, right? Anyway, so Mandla sold these ready-made meals out of these pots out of his boot. And what he wanted to do, well, firstly, he wanted to buy more pots and so, and you can see that. He also did for his car, the car didn't want to start. And then later he came back and said, ma'am, I need a loan to start a wagon. Is that a trailer? The trailer business next to a mall. So then we did a loan for him for that. And that is how his business has grown and progressed. Then it's Albakwe. So he makes custom furniture, and he bought some tools to just make his life easier and so that he could produce faster. And then it's Charles, which he sells chickens, and he had the same problem of stock being far away, and he could only buy a few live chickens at a time. And yeah, so we funded him so he could buy a lot more at a time. Sorry, I maybe spoke long about that, but
Don't apologize.
But as I say, thank you. What excites me the most. So now we get to the statistics part. which for some people is very important. So let's go into that. Just quickly on the application statuses. A big thing for me, I think, is that we approved 42% of applications. So I think that's a very good approval rate. We did have quite a few lying in no response and incomplete, and we later changed our system so that those were less. The application amounts ranged from 2,000 Rand up until 30,000 Rand. The turnover of applicants, and this is quite a big difference, is the lowest turnover was 5,000 Rand and the highest turnover was 120,000 Rand per month. Then we had decline reasons. The biggest decline reason was because of affordability, and then the second biggest because of our minimum requirements. Then when we get to approvals, and I know we always want to drive approvals for females, right? But the fact of the matter is 60% were male and 40% were female. But then I must also say the applications were much higher from the male side than from the female side. So I don't think our approval rate was different between the two. When we look at business sectors, the biggest business sector that applied and was approved was the hospitality sector, and the second biggest one was retail. In hospitality, if we break that down, takeaway food was the biggest one, and I think a good one overall. Second, catering and events, and then baked goods and a little bit for hire. In the retail sector, we had a lot of others because it's very difficult to define, what are people going to sell. But spaza shops was the biggest approvals in the retail sector from our side. That was just one kind of shop. After that, tabletop selling, and but hospitality, I think the biggest sector for us. Then further on approvals, payment frequencies, 45% of repayment frequencies were weekly. Then 33% monthly and 22% fortnightly. This was a little bit counterintuitive for me. I thought we're going to go most weekly, second most fortnightly, and then monthly. But we found that, especially in the retail sector, the people said, we don't, our clients only get money at month end. So that is the only time we really sell. Before that, we get orders of what we want at month end. So that was why the second biggest repayment frequency was monthly. The loan terms ranged from 2 months up until 9 months, but our average was 5 months, which what we wanted to achieve was an average of 16 weeks or 4 months. So we came close to that. Fully paid and follow-up loans, as I already said, we had quite a few follow-up loans. And then defaults and arrangements. At that stage, at the stage of these statistics, we had 2 repayment arrangements at that stage. One person had to be traced, and then our PIR at that stage was 0.41%. And we could safely say it seems like the Pula score is working. So that was at the end of those statistics. Then the bad thing for South Africa happened, and that was the extended load shedding. Load shedding, everyone is from South Africa, right? So I don't even need to tell you, but mostly it escalated from Q4 of 2022 into 2023. Within 6 months in 2023, there were 4,079 hours of blackouts, which amounts to, if that were full days, that it would have been 170 full days of blackouts. This is according to statistics, but I can tell you now, we have this app, right, that tells you when is load shedding going to happen. For the people in KwaMhlanga, the app didn't work. We thought we had long hours, and even in Mabopane, they were just out for days. They didn't know when it was going to come back on, when it was going to go off again. They didn't have if they had the 6 to 8 hours, they would have been happy, but they didn't. It was just off. So it was much worse for these people actually than we think it was, to be honest. Then the reality for them, no electricity obviously means less production and sales and the loss of perishable goods. You can just think they went and bought stock, meat and so on, and all of a sudden electricity off for days. What happens? So we had requests for additional funding to pull them through the difficult period, especially to fund assets which could help them cope without electricity, such as generators and gas appliances. But unfortunately, we did not have the capital in the pilot project to accommodate those needs. Business owners had to use business capital for their household expenses, and many went out of business, and those who survived took a very big knock and almost had to start from scratch to rebuild their businesses. So that's their reality. What was the reality for us as Kula? Many clients, including some of our best payers, could not pay their debt. As a private lender piloting a solution that addresses the most difficult market with no support or credit or guarantee assistance, we decided to halt the pilot. And the recovery has taken time, but it's only now in Q3 of 2024 that clients are starting to call us to make payments on their debts again. So and I'm going to be honest, for me, it was a very big blow, this whole load shedding and, having to halt the pilot and so forth. But I think in the end, it is a blessing in disguise, because what we learned from this is that as soon as it's going better with them, they contact you to start repay. They do it out of their own. And it's not like, in the beginning, it was mentioned, the willingness as well as they can repay, but they also want to repay. And this shows that most of them always want to repay. It's just if they can repay, which is the problem or the question. Okay, then next, pilot learnings. The first thing is that not every business owner has a smartphone, but mostly there will be a family member that does have one. Data interruptions in the loan process occur. Well, there's interruptions because of a lack of data a lot of the times. WhatsApp is their preferred communication method. The references was a good thing to ask, because we found that a lot of the times they will start the application process, but then they can't provide us with legitimate references. So that was a good check. The ownership, many people run their businesses as a family unit, not as individuals. So you can't always say it must be a sole owner, because a lot of them will say, but this is I'm doing it with my husband, or I'm doing it with my brother. Then record keeping, most do not keep written records of sales and purchases, but when questioned, they can easily give the information off the top of their head. CIPC registrations, 60% are registered at the CIPC. And this was quite a surprise for me personally, but most do not follow corporate governance. So that's the other side of it. So we think sometimes they are formal because they are registered, but the way they do business, they're not doing business in a formal way. And then bank accounts, 90% have bank accounts, but minimal cash flow is reflected. And then only one bank account is used. They would either have a business account or a personal account. They won't have both. Affordability. So this market is totally different from the consumer credit market in the sense of, and I explained this yesterday as well, consumers in South Africa are very inclined to, they just want to know what is the most I can borrow, right? Whereas when it comes to these micro enterprises, they will kind of stop you in the process before anything and ask, how much am I going to repay? And they will tell you, just remember, I won't be able to afford more than 500 Rand a week. They know exactly what they can repay. I'm not saying throw affordability out of the equation. Affordability is important and it should be done. But I think as a pilot, we did these affordabilities with questions and not always asking for, give me all of the proof of what you are saying. And it proved to work very well. Okay, and then the pilot learnings from a business model side, the loan process. So the steps in the loan origination process had to be changed in the pilot to collect data throughout the process, as opposed to all of the information up front. So all of that information, asking them all of the questions up front, sometimes had them stop in the middle of the application process. Whereas if you break it up and you ask them throughout the process, okay, you know, at this stage now I need these questions answered. It had kept them involved, and it was much better that way. The hybrid loan solution, so despite the technology-driven process, significant human intervention was still required in the loan application. A lack of data on the consumer side and obtaining quotes from suppliers emerged as particularly time-consuming challenges. Sorry, my mouth is so dry. Can I ask for a little bit of water? Stumbling over my words because of that, sorry. Thank you. Then zero-rated data. So data costs are a significant constraint for them, and it also makes the loan process much longer because we need to wait then every time for them to get data. So we would say that communications with clients should be zero-rated. Survivalists, we found that we can broaden our target market to include survivalists, which is, those are the people that has a turnover of less than 4,000 Rand a month. And we did include 2 survivalists, and they are still very good payers, and it's amazing to work with them, but they are very time consuming, and you know, there's a lot of hand holding needed in the whole process. So more human intervention is needed in those circumstances. Sorry. So patient capital will be needed, as external economic factors, for example, the extended blackouts, can be detrimental to micro entrepreneurs. Even the best clients will default in such circumstances. Thus, patient capital is needed. And then going against the grain, and I think this is the most difficult thing for a micro lender. If external circumstances cause a good paying customer to default, there should be an option to help them through the difficult times with another loan, even if they cannot pay the one they have with you at this stage. So, and I've actually tested this. So I went out myself and I said, I will pay these loans if they don't, but I'm going to test it. People that couldn't repay previously, and I believe they're going to repay me if I can just buy them stock again. And they're repaying perfectly. So it is going against the grain, but I do believe it is important. Then natural progression, micro entrepreneurs want to increase their loan amounts as their businesses grow. So different credit products will be needed. So we capped ours at 15,000 because of the fact that the total return on investment is, the higher the loan amount gets, the smaller your return on investment is with the cap on the initiation fee. So going higher than 15,000, the risk is becoming too big for the reward, which in that case, you know, you can't really go for these very big loans later on. Right. And then the conclusions. So the first thing is Khula's mobile-based loan origination system and digital loan management system works. So we have this successfully distributed money to micro entrepreneurs in informal settlements via their smartphones using our innovative technology. We also successfully received regular payments from very remote areas. The second thing, our scoring model works. So our unique alternative data scoring model, built specifically for this market, has proven to give accurate predictions. The makeup of the score is based on years of experience working in this market and comprises a combination of an individual score, a business score, and a social score. So, and it obviously also came from the learnings from the IEDP. Then Khula's alternative score is continually evolving based on ongoing learnings. The third thing, alternative scores for individuals from bureaus have the potential to enhance Khula's score. So what we did is, after the fact, right, after we knew how these people repaid us, there was a bureau that said, okay, we'll give you an alternative score for those customers based on the day they applied for the loan. So what would the alternative score have been on the day they applied for the loan? They gave us those scores, and we deducted that we could have had 50% less in bad debt if we used that score on the day of application. So that's the first thing that we deducted, which is obviously very good news. And remember, this is 50% less bad debt during this whole process of 6 months of extended blackouts. So our bad debt would have been much less if we used it. What we also noted, and this is very important, is that if we only used that alternative score, some of our best clients would have been excluded from their loans. So it is very important to have a hybrid between our score and an alternative score from a bureau, but the alternative score from the bureaus can help a lot. Okay, and that's me. Thank you.
I think there's, it's no surprise to why we decided to work with Royal Finance, not just based on the incredible experience they've had in the base of the pyramid, but Mariette's personal passion to see these small businesses funded and knowing them by name. We've had hours and hours of conversation about each one and what they do. So it was a real privilege to work with her. Just a little side note, I remember her coming down. Our business is based in Durban and she's in Pretoria, and she came down for a weekend. And our exciting Friday night was sitting on the couch with our computers and our pajamas talking about these entrepreneurs. So I think we're quite nerdy, to be honest. So let's look at what's next for the Kula pilot. So in phase 2 of the project with the IFC and NCR, and we're going to give some recommendations just after this around some of those learnings and how possibly some of the regulation constraints, how they could maybe be looked at. But for us personally, we want to look at an extended pilot and really going 10 times bigger. So instead of 500,000, we want to look at 5 million. Instead of 90 loans, to do 900, and 540 applicants with the ones that take loans again. Those are just average figures, and we want to extend the period from the 8 months to 18 months. What we need to make that happen is, first of all, the 5 million to actually disburse, and then we want to raise working capital to actually boost the dedicated team to actually work on the larger pilot, and to also take our MVP. So the system, and largely a brainchild of Mariette, that has been put together to be able to collect the data, to do the scoring in an automated way, and then actually the loan management system to manage the loan once the money's been given out and the repayments. That has been done as an MVP, and we want to actually enhance that now into something that is far more scalable. And then lastly, look at a credit guarantee instrument. So, for us to move forward, this is what we're having a look at. Both of us, fortunately, and like our recent meeting with the IFC, we both run separate businesses that actually look after our staff and our income that we use to stretch into this particular project. But I think the pilot has shown that there's a lot of merit in being able to provide this type of funding. So just in terms of recommendations, so just to start with, I think Mariette spoke about the initiation fees. So at the moment, the initiation fee is a fixed fee, and we would recommend that it changes to a percentage of the loan, because obviously as the loan gets bigger and more risky, there's less reward. And so for any potential financiers wanting to come into developmental credit for micro enterprises, it is something that is a deterrent. The affordability requirements, Mariette covered very well. To say it's very different to consumer lending in a sense, and the fact that there aren't formal records to substantiate that affordability check, the figures speak for themselves in terms of how that information, and maybe the NCR and IFC taking a closer look at the questions we ask and the process that we go through. But you're not going to get handed an Excel spreadsheet or something formalized. It's all about engaging with the entrepreneur and understanding those inputs and outputs. Thankfully, I think this one is already being addressed by the parties, but it's movable assets and allow the attachment of movable assets for the developmental enterprise loans. So right now, there's absolutely no recourse if someone doesn't pay. And what we are saying is create a movable assets register where it can be documented when an asset is attached as a collateral for a loan and actually allow that attachment to happen. So that's currently obviously not in place. Then the next one is also quite interesting. It's around the fixed interest rate. And to grant a fixed interest rate, currently developmental credit is linked to the repo rate. And I'll read this because it comes off Mariette's tongue easier than mine, but it says a higher repo rate becomes a reality in a challenging economic circumstances, which causes problems for both the lender and the borrower. For the borrower, an increasing repo rate makes loans too expensive for small business owners who are already cash-strapped in a struggling economy. But for lenders, a varying interest rate causes uncertainty, and lenders would prefer a fixed interest rate which allows them to plan for bad debt percentages, operational costs, etc. So the last one I'm going to go through, we'll just leave those recommendations there, and I think these have been forwarded. But I think the biggest inhibitor to more players that are doing short-term lending to consumers, and we know that that's a very big market of lenders, I think currently, and I stand under correction, I think there may be 20 registered developmental credit providers or those that are active. And as we saw in the previous slides, that in other economies, this particular type of funding can actually change a lot of what's happening in the base of the pyramid. And currently, the developmental credit regulation is scattered throughout the National Credit Act, making it difficult for potential financiers to understand how to register or how to be operationally compliant. So if the NCR wishes to see more financiers providing this important finance product to this underserved market, then it needs to make it easier for credit providers to understand the NCR requirements or the regulatory requirements. First prize would be to have separate legislation for the developmental finance outside of the NCA, or failing that, to provide an easy how-to guide for aspiring developmental financiers. And inside of that, it should not be interlinked with any other credit legislation. It should only be developmental finance in South Africa. Now, this is our wish list, and we can stand up here saying that as entrepreneurs, but that's what the forum's for. And, you know, if we get half of what we ask for, it will be amazing. It should also be short and easy to understand as possible and provide very clear guidelines on how to register and stay compliant as a credit provider. It's imperative to allow practical enforceable recourse for the lender in case of bad debts. It should also incentivize all credit providers to become involved in developmental finance, not just the brave few, but the bigger institutions. It should incentivize informal enterprise owners to register formally, for example, by granting tax exemptions or even higher SASSA grants when they are retired. And then we just want to reference, and this came out of the IDP that Mariette was involved with, Brazil's National Program for Oriented Productive Microcredit, the PNMPO, is a great example of short and concise regulation for developmental enterprise credit and how to incentivize all economic role players on how to participate. So this is the end of just talking about this pilot, which is what we did for enterprises that are turning over less than R1 million, that are in remote areas that don't have access usually to financial inclusion. Just in ending, I just want to talk about, so where to from here for Kula, for phase 2. We've already said we want to go a 10 times bigger pilot, and we welcome any players in the room, anybody that is interested in coming alongside of us and coming alongside in terms of capital. We've shown the returns and what can be done. But in terms of the SMEs that are turning over R1 million and the phase 2 pilot, we actually are partnering with Experian, and I know Jaco, the head of the Innovation for Africa, is going to be on the next panel. We've been working together for many, many months now. And really, FinFind, as I said, we've got 1.3 million users that have come to our platform to request finance. In our back end, we've got every funder from the public or private sector, 313 funders, over 600 products. And we know the detail of every one of those products and what their funding criteria is. So we're a little bit like the Tinder of SME funding. The SME wants funding, and the funders out there. And the big problem often is that they can't find each other. Lenders are looking for a ready pipeline and of businesses that they can fund, and the SME just doesn't know who are all of these funders. Many are going to the banks and obviously not being able to get satisfied with funding there for various other reasons. That's for another conference. But what we're wanting to have a look at is we collect data, we verify with Home Affairs, with SIPSI, all of the information that is provided, so it's kind of do a KYC up front, and then we collect all self-reported data about what you want money for, how much you turn over, all the different areas, and then at the end, they have to upload documents to verify turnover, to send bank statements, and then we do credit checks on the principals. Through Experian, we are going to be doing a lot more APIs and building a new workflow, an enhanced workflow that can actually start to generate this alternative data in a better fashion, and then use machine learning to build out the basic management account information to make predictions. And I think that the coming together of a fintech who's working in innovation and a bureau who's very innovative together is going to change a lot. And the last statement I want to make is in that diagnostic landscape or landscape diagnostic that the IFC and NCR did before the start of Pilot 1, FinFind was actually asked to do the peer review on that particular report. And there was a statement in there that was made that what is alternative data? Like, how do we understand it? And really, what it said in there was any data that is not held by the Bureau. So when it comes to business, that's probably almost all data. Because really, in terms of scale, bureaus have the data on the principals and they have the data from SIPSI. The only other data is some trade credit data, and otherwise, people who've managed to get funding from a bank. And if you've managed to get funding from a bank, then you don't really need alternative data because it's a very small percentage of bigger businesses. So what we're looking at is how do we be able to tell a lender, look at this business and we can tell you that is a viable business that's hitting a cash cliff because they have been paid late by government or corporates, and we need to try and intervene. And that's what phase 2 pilot's going to do. So very excited for whenever we're going to meet again, and we can give you some of the learnings from that, tell you how many people have been funded and how many jobs have been saved and created, and then give you the feedback on the enlarged Kula pilot. Thank you all very much for your time.
Thank you, ladies, very much. I admire your energy, resilience, and creativity. Looking forward to the next phase. So as I mentioned before, the follow-up of these presentations is a panel. So the next panel is going to be moderated by Colin Masunda. He's a credit information and data specialist for the IFC, also secretariat for the ICCR, also the project lead for this project here in South Africa. What else I'm missing? We can call his panelists Lee, Jaco, Tish, and Tupang. Do you have enough of it? It's
very tight.
Well, your family.
Thank you very much. I'm not going to waste time because we are now behind time. I've been inundated with a lot of WhatsApp messages on alternative data, which has made me to decide to change the questions I wanted to ask in terms of order and all of that. So the burning question in the room, and I'll start with you, Jaco, is what exactly are you guys talking about when you say alternative data? Can you briefly talk to some of the data points that you guys are a global company? You have tested alternative data in several markets. What do you mean when you say alternative data? What exactly is that?
Yeah, I think and thanks for having us today. And it's a real pleasure and exciting to sit here and listen to all the great initiatives that's going on. And I think Darlene and Mariette summed it up perfectly. It's any data that is non-traditional that the Bureau doesn't have, right? So the easiest way to explain it is to say, well, if you work in an environment like the pilots that was done by FinFind, and you go look at what is important in terms of the joining demand and supply, you need to look at an ecosystem. And when you look at the ecosystem from the small business applying for finance and the supplier at the tail end, or the funder at the tail end supplying it, you need to ask both of them, what does success mean for either? And there's a big mismatch between the two. And what alternative data actually is to go through the entire process that small business goes through in that application process, and looking at each point where they fail, and taking that data and say, how do we use that specific data to enhance the journey for that small business to get to the funding? And as Darlene said, we've looked at quite a bit of work. We've done quite a bit of work with FinFind, and we looked at over 1,000 applications. But for every 100 applicants for small business finance that comes through the FinFind platform, 8 are successful, and the 8 that's successful gets 33 cents in the rand granted of the finance they want. Now, if you think just about that, and you go, well, if only 8 is successful through this entire process, where do they drop off? You very quickly find that a lot of these applicants drop off at a point that is based on the first question. If you're going to ask for finance, you need to be good as an individual. And if the principal isn't great and the principal credit profile isn't good, you're not going to qualify for funding from any suppliers, for any funders at the back end. And when you then need to solve for that problem. You need to say, well, the reason you're not good, I need to make it very simple and easy for you as the applicant to understand why you're not successful, why your principal record isn't good, and how to fix it. Because if you don't use the data you gather at that point to give advice in terms of fixing it, it's pointless. All you're trying to find is 8 people and trying to improve efficiencies for 8 people to get finance, when we know we need to get 50 to get to finance. So that's one example. How do you get the person applying and collect the data at each of those phases to optimize that journey for all consumers, for all applicants? And there's multiple phases, but there's 3: as an individual, and then there's funding readiness. And the funding readiness data has got nothing to do with financials. Is, do you understand what you're asking for? Do you understand the type of products out there? Do you understand what it means when that money is paid to you, how to manage that money, and how to make sure that your credit record remains intact, whether it's your individual or the small business, is used for a next loan? And then there's the financial readiness. And we can talk for hours in terms of financial readiness. If you're going to lend money to small businesses and you expect them to provide you management accounts, I think we're joking and we're naive if we think that we're going to turn the economy around by expecting management accounts and cash flow projections from small businesses. It's not going to happen. We were very fortunate to sit with the Department of Small Business Development in a 2-day workshop. And the most amazing thing for me at the end of the workshop was, do not try and write policy for this market. They will find a way around it. You need to take the data from step to step. Alternative data is literally at each step, how do you use the data to enhance that flow through from 8 in 100 to 20 in 100 and get the 33 cents in the rand from 33 to 50 cents in the rand. Because for every one you get at a higher loan amount, we create jobs, to Lee's point earlier. The only way we fix this is not through over-regulating it. The way we fix it is by making it simpler and using data that's non-traditional. And it's going to take top-down different views. Now the Reserve Bank is here. You're going to have to look at this very differently. This is not, I have a mechanism to manage my capital at the bank and the impairments because I use certain mechanisms. The moment you start using alternative data, you cannot apply the principles you do today. And that's why it's very interesting and exciting for us to work with FinFind, because that panel of 300 lenders, there's the banks that's regulated through the Basel capital requirements, the IFRS 9 impairment requirements, but then there's the Mariettes that will get into this market that's not governed by that, that will use this data to make a difference.
Thanks, Jaco. I hope people are beginning to get a sense, but I'll come back to that question because I keep getting the same message. Let me pass on to Tish. You are the new kid on the block as Noto. Can you briefly talk about why you guys decided to focus on render?
Thanks, Colin. So as you said, we are the new kid on the block. We are an alternative credit bureau, and we decided to focus on the underserved market, particularly because we wanted to achieve financial inclusivity. And there's a lot of people who have not been able to attain some of the opportunities so that they can have financial growth through finance. And also, coming from the same background in those communities ourselves, most of the team at Noto, it's not just a professional, it's not just a professional passion for us. It's actually personal. I actually know some of my aunts and some family members. When I look back, when I was a little girl, they were still in the same place. They didn't have homes, they didn't have cars and so forth, and their businesses struggled. And when I look today, they're still in the same place. So we actually want to make a difference. And at Noto, we actually went down to the communities. We dealt with them face to face. We listened to what they had to say. And we changed our operating models to make sure that the information that was received, we give back to them. And we make sure that everything that they've actually said to us is the way that we're able to service them, just that we can make sure that there is success.
Lee, same question, because like I said, I got a lot of questions around. So Yago was talking about principal data, and I think Darlene and Marriott also spoke about it. Principal data, individual data, and business data. TransUnion has globally has released a lot of alternative data driven products under the CV link. Can you briefly talk to that and give some examples of what you guys have done in other markets? Because I think I see this across several African markets. We start believing when we hear that it has happened elsewhere.
Well, I think the reality is that we as Africans don't believe generally. We need to be convinced, and when we're convinced, we need even more conviction before we need to be convinced. So it takes a lot of time. But what I'll tell you is that if we look to other emerging markets specifically, then actually I think believability improves. Because if I tell you it works in America, you won't necessarily believe me, right? So I think if I look at places like, I've looked at Brazil, Colombia, looked at the APAC region, including India. So we've got a flagship product called Credit Vision, and that's the one that, it's more than the score, it's a story. And we've been able to, so what Yaku said is important. Alternative data, in a short definition, is non-traditional, non-financial data. That's the way we think about it, right? So, and the variants across the world, not necessarily here, have included the use of retail POS data. So what you buy, right? I was speaking on Makata earlier. I said, like, where's your iPhone? Your device could infer something about you. So whether you pro Samsung or Android versus iOS, that's an example. We've used examples like tenant data, whether you pay your rent on time, right? That's become another alt bureau similar to what Noto is doing. CDR data, so telco data, is also an example of what is non-traditional, non-financial. Think about the point I made earlier. Africa has got 515 million smartphone users, right? That must be interesting as you think about a new source of data. So the general point, though, is that you may make the point that principal risk and deeds is, it's so simple. The reality, though, is that it's actually not mainstream data, right? Even though the data is publicly available, Colin, it actually isn't used to the way we'd like it to be used. So when the NCR thinks about where should I focus, there's publicly available data that if it was consistently applied, could give you the first release of value. Because as you look to move downstream into what Noto is doing and FinFind is doing, there's another space where you can attack the problem from the top going down and from the bottom going up, where FinFind and Noto are playing. So I think there's easy pickings, principal, deed, asset-based data. Then as you move down into things like retail, CDR, telco data, those are also opportunities. I think the point I'd leave you with is that it is very, very difficult to get mainstream adoption. You know, it's more than just FinFind, what Dalian and Marietta have presented. It's more your heart driving the project, because it's hard work, right? And you don't have a lot to show for it yet. So I think it's a multi-pronged approach with all data, not just, guys, let's start from the beginning. Let's learn, let's borrow, let's see what others have done, but don't start from scratch. That's my take on all data and the examples in every single country in the world.
I think we are getting there in terms of the definition, and I've stopped receiving WhatsApp messages, which means that we are making progress in terms of defining data. So Tupang, based on this, and you touched it briefly in your presentation, Lee spoke about telco. Telco is not under NCR. I think Yako spoke about cash flow data, which comes from bank statement under SAP. This requires a village in terms of the stakeholders that should participate. What is NCRS thinking in getting the other regulators, some which are financial, and these are closer to you, and some which are not even financial, to ensure that we start a conversation that is going to help us?
But we have current regulation 1913. We have said that compulsory for providers to share the. But for entities that do not regulate, there's telcos, and what we have stated there is that there needs to be proceed. So it's insurance. Commission as the credit bureaus should also commission. So currently working very well, the reciprocity principle, but we believe and it should by involving the regulators, particularly for non-compliant. Currently, the big provider doesn't comply with submission of data, we're able to take enforcement action. The insurance company provide for ways to non-compliant stalking acts that we do working with the other regulators can actually enhance. In other words, find ways to operate in interfering within the regulatory framework of all relevant industries. We should be able to interfering.
Thanks. And I'm not a panelist, so I don't want to share my views on that. But I want to emphasize that this will take a village for it to work. We will need the cooperation of other regulators and even of central government, because central government is also sitting with a lot of data that can actually be useful in helping push the conversation. Let me turn on to you, Lee. You did the testing. How was the reception from your incumbent financial institutions, your traditional financial institutions in terms of uptake? And what do you think we need to do to move the needle in terms of that?
So I'll cover the things I didn't cover in my presentation earlier. I think there's an apprehension, I'd say, in terms of all the people that regulate the industry in terms of downstream consequence, right? So I think when you have a smaller ticket loan that can be repaid in a short space of time, that's fine. But as you move to a larger ticket size, the question is, when that loan impairs, right, what's the consequence? So I think in the blessing of the pilot was there was sanction to go about testing this, but I think the believability wasn't there. In fact, I remember I had to say to Luz and to Noms at the time, I need a letter with all our logos and all 3 signatures before I can start, because it wasn't believable. So I think we have a set way of working. So the one point is, more than just education, you need to believe that the environment allows you to do this. So I think I'd say point 1 is the edict that, guys, we are doing this, welcome to the party, you're part of my village. It has to be more than a cocktail party, right? It's almost it's regulatory environment endorsement. So I think that's one. The second thing is, I think we need to realize that private sector organizations, specifically financial services players, have a lot of challenges already. For anybody to embark on another pilot amongst the other 1,500 pilots they got is a challenge. And I think some of the challenges is that some of the pilots don't give as much return on investment, right? And like we've seen, for example, if I use a load shedding example, just by giving an incentive to residents and to SMMEs, today we enjoy no power outs, right? Incentive was massive and significant. I think the incentive to do another pilot isn't as compelling when you got 5 other things to drive revenue growth, because we must remember that private sector players are minded by revenue and margin. So is the incentive strong to do a pilot? I don't think as strong. Those that participate took a lot of hard miles to get them on board. That's the second thing. And then the third thing I'd say is this data, non-traditional, non-financial data, we worry about it. It is early days for us under privacy regulation. How is the data managed? What is the connection between business and principal and consumer and privacy regulation? That's something that is not stable yet and is being worked through. It's always a question as to downstream implication of a short-term choice. Those are my 3.
Thanks. Tish, you entered a market that is already overcrowded. How are you finding the terrain, and what do you think can be the role of government, of DFIs like IFC in helping you navigate as an industry?
Colin, I think from the government sector, I think 2 things. One is education. It is so important. As NATO, we invested in a training academy. We got resourcing from the community for people to train everybody around what it is that we're actually doing and how we want to include them within this particular market. And we're actually astounded by the number of people with, I guess, a false narrative around, credit scoring, what it actually means. I'll give you an example. They actually believe that when you are when you're blacklisted, they call it you're on credit bureau. They don't understand the difference, what lenders actually play, what credit bureaus actually do. And it's such a personal matter for them. So it's quite important to actually have those face-to-face interactions, because people are embarrassed about their finances. People are embarrassed about not being able to get finance. So I think education from the government, from them driving it, that's very key and critical. I think the second part is to look at legislation, and this can be opened obviously for debate, but to look at how do we actually incentivize corporates to be able to participate in this particular space, and basically for their employees' financial welfare. Imagine how many companies have got call centers, cleaning staff, so many other staff members that can actually benefit, but they're not being able to play in the space. And we know that legislation drives positive behavior. And I think for the rest of the other entities, let's look at funding mechanisms. I can imagine the number of startups who want to play and contribute in the space, but they don't have the means to be able to contribute and continue. It's a very expensive exercise. We've been in the sandbox for 4 years, and touch wood, we are exiting and submitting our final findings. But we know that it takes financial and substantial financial arm to be able to get to the other side successfully.
On and off. Jaco, on the FinFind pilot, what has been your sense of market readiness? Have you started engaging with potential financial partners, i.e. the lenders, to participate in that pilot? And if so, what has been your initial impressions around their willingness to participate?
Yeah, let me be honest, there's no shortage of supplier funding, and there's huge interest in becoming part of this. All you need to do is fill that gap. That mismatch between demand and supply needs to be addressed. And there's numerous ways to get alternative data available to everyone. And I agree with what everyone said earlier, the more the merrier. This is not about an organization doing something different. It is about the country and about fixing what's happening in South Africa, and that's important. So the key thing for us, and why FinFind, we are firmly of the opinion, after going into detailed research on this, that you don't fix this without an ecosystem that brings demand and supply together. You can build the best alternative data models or scores in the world. They'll just stay fancy models if you don't have a mechanism to deploy. You can have the greatest tech in the world if you don't have a mechanism to deploy. It's not going to make a difference. So from an Experian perspective, we've got the skills and the capabilities across the world where we've tested and we've proven, and I can categorically state here today, that using bank transaction data as a risk indicator is as strong as a credit bureau score. Same. Only banks have access to their data. Why not give access to transaction data on consumers and businesses to institutions on the stage or anybody else out there that has the ability to extract value from that data and make that data available to create inclusivity? And again, I'll categorically state it is as good as a bureau score. Can prove it, have proven it. The key thing, though, is that you still need a mechanism to deploy those insights. And that's why companies don't underestimate how important ecosystem developers such as FinFind and other organizations that have the same are to the success of driving inclusivity in the economy. And for us as Experian, we've got a purpose. Our company purpose is to create a more inclusive credit economy that's more diverse for all South Africans through using data for good, but principally by being the change. We're going to be part of pilots, etc. We will be part of conversations, but we're done piloting. We're doing this with FinFind not to create a pilot to prove that it works. It is to scale a solution through partnership between an ecosystem and a company like Experian, pulling in multiple other fintechs. As Lee said, it's a partnership. It's not us. We can't do it ourselves. Pulling in and fixing each and every phase of those ecosystem to bring demand and supply together. And as I said, this is not a pilot. We'll be deploying this and we'll take it to scale within the short term with the intent of resolving the unemployment crisis in the country. Because as much as I love to attend conferences like this and having conversations around alternative data and et cetera, if you don't sort the unemployment problem, neither myself nor Lee will be sitting here because there'll be no one to be selling credit reports to. And there'll be no user or issuer of credit out there because we can't keep lending to the same consumers. The consumers that's active in the market today are so over-indebted. And we're lending to the same people over and over again. If you look at the credit active population in South Africa, 80% of total outstanding debt sits in the hand of 12% of people. Now, logically, it's home loans and vehicle finance. And if you go look at that 12%, 2.5% of them holds about R1 trillion of that. And that 2.5%, 75% of them are principals of businesses. Now, if we're going to start thinking, let's fix small business, it's pointless fixing that 2.5%. They get access to finance. We need to fix the excluded. And the only way you fix the excluded is by using data differently and making that system very different to what we do today. And with companies like FinFind and other fintechs that access transactional data, and fintechs that we work with to implement an end-to-end solution that doesn't only bring demand and supply, but takes it a step further, resolves this entire insanity around procurement of services, where you might be a business that is a solid business with growth potential, but you can't be onboarded. You need to fix the procurement thing as well. So from our perspective, as I said, our intent is no more pilots, get in knee deep and fix this thing. So use data for good and be the change. Otherwise, all we're going to do is have workshop after workshop.
Thanks, Jaco, for that. Tupang, I'll come to you, then I'll open up for questions. We've been talking about the nice things on alternative data. I know that some people are still worried about the risks, the potential risks. What is your thinking as the regulator in terms of how we can be able to manage it? I can preface that question by indicating that we are all for throwing the bathwater, but keeping the baby. So how do we ensure that we keep the baby and throw away the bathwater?
Because definitely with alternative data will be how to extract our financial opportunities to active trading, but at the same time protecting consumers. We are already aware from the markets that have already piloted alternative data, the types of risks that they have. The first one being potential discriminatory outcomes, and this is informed by the lack of transparency when it comes to alternative data. And our thinking currently is that that will require a regulatory framework that will render the use of alternative data or the variables behind alternative data transparent. The other risk that is sitting on the other side that we are also aware of is from a consumer perspective. We are aware that from the markets that have used alternative data so far, that consumers are able to manipulate alternative data to get the outcomes that they are looking for, especially alternative data such as social media. So if a consumer becomes aware that how they use social media can increase their access to credit, they can manipulate that data so that they can access credit. So for on that side, I think the trick might lie again in creating a regulatory framework to manage the risks of consumers manipulating alternative data, because once they manipulate to create an outcome that they think is favorable for them, it will introduce risks to the market, because how they will appear to credit providers might be that they are not risk prone, whereas in actual fact, they will be introducing risks. So we're thinking of a framework to address those risks. But in addition to that, I think it has been mentioned, we will require a lot of consumer education, because issues of consent will also become, as well as data privacy will become topical once alternative data is mainstreamed into the ecosystem.
So that I know that your fellow panelists would want to respond to that. But I want to open up for any questions before I come back to you guys. If someone has a mic, I see a question there. And I see another one at the back. Yes, that's why I decided to truncate the panel, because I kept getting a lot of questions and I felt it will benefit a lot of people to hear the questions. Please go ahead.
I think this problem is larger than just the grouping of people that is excluded from getting access to credit at the moment. And I speak for myself as an entrepreneur. I've got a cattle farming operation near Henneman, and I've got a small IT business. And there was an opportunity to buy 100 head of cattle, and I needed 2 million rand to go and do it. My livestock on my farm is worth 9 million. The bank would not give me that money in the name of my company, but they were quite willing and happy to do it with me as the backing. Another example, a friend of mine at the tender age of 46 retired recently from Standard Chartered Bank as a global head of cash because he was bored in his job. I don't know how that happens, but be it as may, his dream was, I'm going to move to Dullstroom and retire there. So he bought 5 properties in Dullstroom. So those of you that's familiar with Dullstroom, everything from the Mayfly, 5 buildings down, belongs to him. In 6 months, he set up 6 companies, all of them profitable, and he opened up a 160-seater restaurant called The Banker. So next challenge, he moves to Cape Town to go and start a new business there. He wants to buy a property. The way he wants to do the deal is rent the property for 6 months and then buy it. However, because he does not have a payslip at the moment, he cannot rent the property. Now, I'm talking about an individual who in his personal art collection has got 2 original Tretykovs. In the end, he liquidated some of his investments and just went and bought the property outright. And yeah, within the same day, made a transfer of 7.2 million rand. Our lending system in South Africa is broken from top to bottom. And I think it's because it's overregulated and we are killing people in it. It has become so complicated that very smart people can't even navigate it. And this guy was top executive from one of the biggest international banks in the world. We need to deregulate and make things easier instead of making things more complicated. We write the best laws, but we can't enforce them and we can't make them work. We need to stop doing that if we want to move this country forward. Go and look at India.
Thanks. There's a question at the back and there's one in front there. Yeah.
Thank you. It's Ander from the NCR. My question, I think, will be directed to Jaco. Just seeing from the developments you're talking about and how you set Experian to be like in motion with things and not talking. So I just want to know generally, whilst there's still no legislation per se on the alternative data, are you in a process whereby you are thinking of alternative credit reports in the sense that you would have ones that comply with whatever the law is to date, and then perhaps others that will talk to the alternative data? I'm not sure.
That's a very, very good question. So
hopefully, if there's any intellectual property, you'll also assist with shares.
No,
thank you.
Jaco, I want to take all the questions at once, so that we get done with that part. There's a question in front. Yeah, please go ahead.
Thanks, everybody. Inside.
So, by the way, it will be great if everyone introduces themselves as a faster way of people knowing who you are. Thanks.
Oh, okay. Tapofela from the NPC. I just have a quick question, especially for the bureaus. When you model this alternative data against risk, what does it tell us? What's the story at the back end that it tells us, and how does that influence the cost of capital? Is it cheaper Does it make it more expensive? What generally is the relationship there at the back end? For me as a business person, will it be cheaper for me using alternative data? And then secondly, how does this alternative data benefit me as a business owner, as PazaShop, for example? Can I use it on my balance sheet as goodwill? Given whatever information, whatever data is out there, is it only for the lenders? Can it also be used by myself as some sort of leverage? Thanks.
There's another question here in front.
Okay, thank you so much. My name is Mahautam Patlele from Sakra. Yako, thank you very much for the insightful offer. You said that the biggest challenge with this data is a mechanism to deploy the data. So I just wanted to understand what, in your view, would be the best mechanism that would benefit the whole ecosystem. Thank you.
Any other questions going once, twice? Gone. So I got 4 questions, and fortunately I have 4 panelists, which means I don't need to respond to any. Tupang, I would like you to answer the first one. And Tish, I want to bring you in on the first one because you gave an example of rental. And I would like you to speak a bit on that. Then Yako, there are 2 questions that were directed to you. One by Mahauta on the mechanism, and the second one from NCR. Then Lee, you can touch Tsepo's questions. Essentially, they are you spoke about the story and is asking about the story. So the story, what does it mean for capital? And how do I use it as an individual? And I like that question because it turns this whole conversation to beyond just us. How does it help individuals? Having said that, all of you have an opportunity to also opine on any of the questions. So let me start with you, Tupang.
It on. I think on the question of policies that are hindering access to credit, obviously as the NCR, we are in favor of regulating the space for consumer protection. But yes, we do also accept that the regulations can be made easier, which is why we're here today. We really, as I have stated below, we really believe data can unlock some of these impediments. For example, I know when we had this, we're holding this discussion on alternative data, the focus is more on credit history, but alternative data can also close gaps on income data, where if we collect alternative data or any data, because when you look at the National Credit Act, actually income data can be collected by credit bureaus, which will mean that consumers will not necessarily have to carry pay slips, that a credit provider can just access both historical data on debt repayment as well as income data from credit bureaus. So with our work on data, alternative data pilots, we're not only looking at closing the gap on credit history. We're hoping alternative data can actually close the gap on income data so that we can get rid of the need to carry pay slips and bank statements. So this project essentially is us trying to ensure that whilst we regulate the space to ensure consumer protection, we can still allow for flexibility. Thanks.
And I think Lee, Tish, and Yako, as you respond, also please feel free to opine on the use of bioclimatic data. If none of them responds, I'll touch briefly on that because he gave an example of a cattle farm. How are you as bureaus incorporating some of that data to be able to help in assessment. But Lee, you can start with the main question.
Thanks. I think I'll make up the question as I go. Tsepo, I think your question about the story is interesting, right? So I made the kind of tagline is score more, score better, right? And what that basically means is that in the traditional sense, for someone that is previously not a well-known customer to a lender, right, you would not benefit from any improvements in interest rates or cost of capital, as you've said. What we found is with alternative data that you can build a score that ranks in a certain way, meaning it has the predictability you're looking for, that can infer something better about somebody. So in the past, I'd say that in the absence of using alternative data, we couldn't, not just as bureaus, but as the lending economy, figure out exactly what to give you. Alternative data allows us to fine tune as the industry those cost of capital questions that you had. Is it something that works really well? Absolutely. In our business, we've been using it as early as 2018, and a large majority of our clients use it as a primary mechanism. And as I mentioned earlier, alt data doesn't mean something that's fanciful, like social data. Anything that's not in the mainstream, that's not financial, can classify. So two answers. I think one point to make is that it does in fact give us the risk metrics we need to create predictability. And we look at things like the Gini or the KS score, which is predictability of the score. We look at things like approval rates and bad rates. And given all our own data, which I can't share publicly, I'm happy to say that it gives you a better fine-tuned ability to reduce the cost of capital. And the second point is that alt data is something that's available today. We just aren't using it, right? We've been used to using data in a certain way for 40 odd years. Then just to make the point if I can, to support what Ntupong said, the fact that we the regulator has embarked on this pilot of, for the last few years, in itself is a commitment to innovation. And I think innovation takes a long time. Democracy is 30 years old. It'll take us a few generations to solve this problem. But I think it's worth pointing out that we don't have all the answers today. I'd like to believe that we've started the journey in Ntupong, and it'll only get faster as we scale the progress. But, compliments to everyone involved. It's not just the NCR, it's the IFWG with the SARB, everybody playing together to drive innovation in an industry that's been working for decades. It's a compliment that we've started. We're not there yet, though.
Thanks, Lee. And Tsepo, on your question of how you can leverage that, there's a lot of thinking and research around that. And one of the answers to your question is your earlier question around how this data can be useful on the cost of capital. So in the US, and I don't know why these two gentlemen did not talk about it, they've gone on a campaign where they say to consumers, if you want to report your utility data, you report your rental data and some of the alternative data. Experian is a product called Experian Boost. TransUnion is a product called Credit Vision. What it does, it allows you to get a lift in terms of the score. The lift in terms of the score will translate to the cost of borrowing that you actually do, right? So as people get that, you can then be able to negotiate. And a platform like FinFind in the US would then be able to say to you, based on your score and this number of lenders that are available, you are able to choose who is giving you a better deal. So it also then empowers the consumer. You are not just a price taker, but you are able to get, Darlene is 600 lenders or whatever number, I keep forgetting. You are able to click and see what everyone is offering you, and you are able to take advantage of that. So we are doing this not just for the ecosystem, but for the ultimate data owners who are the individuals.
It's worth just making the point that there's a lot that Jaco and I could say to defend both of us. But I would just make the point on alt data. You know, so there's certain set of what we call display rules as to how credit reports show up. With a little bit of innovation on regulation and coordination, it's not too difficult to move that into how the credit report shows up. You know, earlier this morning, the DTIC spoke about cross-border sharing. It's actually becoming a global phenomenon to carry a report with you, right? So as we migrate between places, that'll also become a thing. So I think two subparts, if I can add to that, is that it is possible, but you want to be coordinated, right? We all want to be on the same page. I don't want to do this as TransUnion, but no one else accepts it. It's like I've got a TransUnion badge. They say good, but then everyone says we don't use TransUnion, so it's actually not good. Coordination, which is why we're here today, is to collectively progress the movement. So innovation is there to be had. It's proven across not just the bureaus, but across the world. But if we are coordinated, we'll make more sustained progress. Colin, if I can just not challenge you, but sustained progress is what we want, not radical, short-lived progress.
Thanks. We need a lunch break to convince me on that. Tish, then Jaco, I'm mindful of time. If you guys can respond to the questions, and then we can wrap up.
Great. I feel like most of the questions have been answered. But just to elaborate a little bit more on the rental payments. From our side, we actually track the tenant rental payment. And the premise is, if you can pay your rent in full and on time on a monthly basis, then you should ideally be able to service a home loan of the same or similar amount. But where the catch comes in is that you can't self-report. So we need your landlord to verify all the payments. And I guess in the market, in terms of what we've actually got to learn within the industry that we're in, not necessarily all the tenants and landlords will have a good relationship. And what landlords are concerned about is that you are poaching their customer, they are poaching their tenant. Now you have to fill in that tenant who's going to be getting a home loan at the end of the day. So you need to make sure that the communication is there, people on both sides, both tenants and landlords benefit. But it's a small price to pay for a bigger return in the end, for financial inclusivity.
So you answered that question brilliantly, Colin. You answered the lot. So I'm just going to add a bit more. From that. I think the starting point of this entire conversation in terms of where do you get the data is you get the data from source. The way we get the data from source is going directly to the consumer, or you go directly to the small business. Let them provide the data. The ecosystem I referred to earlier is that ecosystem that the source is comfortable providing that data to because they see a positive service coming from it. So when you have a delivery platform, I'm literally talking about the platforms that the consumers and the small businesses trust, like FinFind, that is the ecosystem to deliver it through. So once you go to source to get the data is covered through Papia, and we can use the data constructively. In order to use the data, it's always going to be complementary to the traditional credit bureau data. So to what Colin said, it would be a boosted score to your bureau score. Or for those instances where consumers are not on the bureau or does not have a bureau score, you can use the scores that you calculate with the data as a standalone score, but you're going to have to back that data with some form of this data is valid data available, such as banking transaction data. A standalone transaction score could mimic a bureau score because it's available at the bureau, it's available at the banks, and everyone sees it, and you can see the transactions that go through. The great question that I got earlier, how do you leverage this on your balance sheet? We started this journey 2 years ago as Experian, and we said, right, we need to go educate the community. And we do a lot of work with Riza Babayile, that's a non-profit, and we go into the townships, and I was very proud, the first one in Diepsloot, and I presented this app to the community. Within 15 minutes, I've never had so much egg on my face in my life. And then I stopped and I said, well, instead of me telling you what you want, but what we can give you, we can tell you your bureau score, we can tell you your bureau report. What do you want? And the simple answer was, we want to be able to answer the question before we go ask it. So we want a mechanism for you to tell us, small business or consumer, when I go and ask for the question, can I need credit? I need to know, am I going to get it or not? Because the embarrassment and the pain that we go through every single time applying for credit and being embarrassed in front of people, when the answer is given, no, you can't, it's terrible for the community. And then it forces them to go get credit from places where they get caught in a debt trap and they can't get out of it. So we completely changed our approach to, well, if that is the mechanism, let's go find out from consumers and small businesses, how do we help you get to the answer of the question? Great in the community, I go to my daughters and I tell them that. The first thing they ask me is, well, Dad, how much money am I going to get from this data? I'm going to give it to you, which you can have, because Apple takes it, Google takes it. What do I get for it? And it comes back to the comment that Lee made earlier. There's different generations. The data is available. People have different answers or different questions in terms of the data. So the easiest way to answer, how do I monetize my data, is if you're going to give it to me as Experian or TransUnion or anybody that's going to get value from it, I want you to share the benefits with me because I've given this data to you. And that is the way how you monetize your data as a small business. You get benefits through the boosted scores that get you a better interest rate, but don't just give your data away for free unless there's something in return, unless you get something for it. If you're not going to benefit from it, why would you possibly want to give it away? And that's where the key sits. The consumer needs to provide it, or the small business needs to provide it, but there needs to be a benefit in return. If I give you this, what do I get? I get a boosted score. The boosted score gets me a lower interest rate that helps me manage my capital. Consumer, I get a boosted score that results in me getting a loan, or you taking this lead that I give consent to take to a retailer. The retailer pays you 100 Rand, I want 10 Rand of the 100 Rand, please, because I came through your platform and I gave you the data. And that is the most important thing. It's not about us. It's about the consumer and the small business. Making them realize that their data is powerful and that their data can get them to an answer before they go ask the question. And then to put them in power of that conversation. That if I'm going to have a conversation with you for credit, I'm not asking you, can I get? I'm telling you I can get. I want to know from you, what are you going to give me? And that's the most, and that's how we create inclusivity, by giving people the power and the knowledge of what it means to go have that conversation from a position of power and using their data to their benefit.
Thank you very much. This conversation will not end because I have people who are passionate about it. And I'm hoping that we have been able to recruit more people who will be interested in working with us. I like what Kidi said in the morning, that so that we not just stay together, but we work together. Please help me thank my panelists for this session, Tupang, Lee, Tish, and Yako. And thank you very much.
Hello. Thank you very much. Thank you, Colin, for keeping the time. So for those that are here still next week, I'm the one leaving, but for those that are here still next week from the panelists, I may have a proposal, but for next week. Palesa, get ready. We are starting now session 2 on small credit providers. Palesa Dibe is Compliance Officer of Credit Bureau of the Compliance Department at NCR, and she will start with the presentation around the text print, lessons learned, conventional means of digitization, etc. Let me just make an announcement before Palesa. Let me tell everybody that there is a Nissan Baki, that's a car, license, I think LP57CRGP, lights on, alarm on since 8 a.m. I recommend that you maybe book a room, but still you can go and look at your car. Thank you. Go ahead, I'm sorry.
Thank you so much. Good afternoon, ladies and gentlemen. My presentation My presentation today will cover a lot of items, but at large, the rationale and the lessons learned during the planning and the hosting of the NCR Tech Sprint event. Regulation 1913 prescribes the manner and form in which credit providers registered with the regulator must submit credit information to credit bureaus. The NCR noted that small credit providers do not have the capacity nor the capability to then comply with this particular regulation. Small credit providers play a critical role in credit allocation in serving the base of the pyramid and the last mile. To this end, the NCR, through the support of the World Bank Group, collaborated on a project for the credit industry to develop an affordable digital platform that will enable compliance by small credit providers. Compliance by small credit providers will enrich the credit information sharing system in South Africa and encourage financial inclusion by markets that would have otherwise been excluded. Lack of digitization by small credit providers has systemic impact. The decreased consumer credit visibility impacts the consumer's ability to secure credit at better terms. Increased possibility of consumers over indebtedness when consumers are able to access additional credit of which they cannot afford. The inherent operational risk of credit providers is increased when credit active consumers are not visible. The use of incomplete consumer credit data for regulatory and policy formation is also affected. Finally, the heightened compliance risk impedes on the sector's ability to grow. Disaster events such as the COVID-19 pandemic, the July 2021 unrest, together with the KZN floods, disproportionately impacted small credit providers, exacerbating the lender's ability to operate as going concern. Against this background, the NCR then selected a vehicle to facilitate the creation of the solution to address the non-compliance with Regulation 1913 by small credit providers. The ultimate end goal for the Tech Sprint approach was for the NCR to have a solution that enables regulatory compliance, encapsulating the following key elements: digital transformation, increased level of compliance by small credit providers, a user-friendly and easily accessible system, and a system that is inclusive of the key stakeholders within the credit ecosystem, and finally, the system that is not built nor maintained by the NCR. The road was long, but we did manage to get there. I would like to highlight the key milestones for hosting the NCR Tech Sprint event. So the stakeholder engagements and the development of the problem statement were concluded in November and October of the year 2022, followed by the hosting of the roundtable discussions with ecosystem stakeholders, associations, regulators, and credit providers in January and February of the year 2023. The problem statement was signed off in March 2023, together with the decision to proceed with the Tech Sprint and the showcase model. In August 2023, the NCR hosted the tech briefing with prospective participants. Tech Sprint and showcase participant recruitment was then concluded in September 2023. Then finally, we hosted a Tech Sprint week and the showcase day in October 2023. Just to share some of the stats throughout the planning and the hosting of this Tech Sprint event, we had 20 individuals from 4 organizations across 3 countries that participated in the tech sprint project. 11 tech hacking teams built prototypes supported by 5 industry floating experts, together with project team members that served as Scrum Masters. These prototypes were presented on demo day to 5 judges and 1 head judge, where the winning teams would be selected based on a predetermined judging criteria. The winning teams would then be supported post the tech sprint week to take their solutions to a stage where they'd be ready for market. The demo day attracted 88 people, and the teams were given 11 minutes in total to present their prototypes. It was recommended that they allocate 3 minutes for the judges to ask any questions. The winning teams were awarded cash prizes of 100,000 for the first place winner, 60,000 and 40,000 for, together with an incubation program, was awarded to the second and third place winners. Team Tasky won the first prize. FinSmart won the second prize, and the innovators were awarded the third prize. For the showcase, we had the same 20 individuals from the 4 organizations across the 3 countries contribute to the organization, well, the planning and the execution of the showcase. There were 4 tech companies that participated in the showcase day, where they presented their already available solutions that solve for Regulation 1913. The showcase day attracted 98 people, and the tech companies were given 10 minutes to present their solutions. Then the audience members were afforded a 5-minute Q&A session. Currently, Team Tasky has completed their end-to-end testing for moving consumer credit information from the lenders through to the DTH, through ultimately to the credit bureaus. They are in the process of onboarding as an ALG with Sakra, and focusing on refining their pricing models and attracting prospective users through their marketing efforts. FinSmart and the innovators took up the incubation program, but the team experienced challenges balancing their work and school commitments together with attending the incubation program that was offered during the week in a virtual platform. Saturday classes were then extended to the participants, but a lack of commitment and general morale came to the fore. There were a lot of lessons learned throughout the process. The learning curve of the project team in planning and hosting the tech sprint event was diminished by the support and the guidance received from experts, expert service providers for the tech sprint. Poor communication strategies adapted to what being the pillar of planning and hosting any tech sprint event negatively impacted some aspects of the tech sprint. The prototypes presented on demo day were very exciting and promising, but unfortunately, it was found that the teams do not intend to pursue any further development in participating with the solutions. So it was found that the participation was either through the motivation of either attracting the prizes offered or to gain experience. Focus should have been on the new operating companies instead of teams that were made up of persons that collaborated purely to participate at the tech sprint. Participating teams made up of new companies would have resulted in a better chance of the teams further developing their prototypes ultimately to the market. Stakeholder collaboration is critical in the automation of small credit providers. Apologies. So stakeholder collaboration is critical in the automation of small credit providers and their participation in the credit information sharing ecosystem. Consultations and engagements with stakeholders throughout the planning of the tech sprint resulted in them being willing to contribute throughout the planning and the execution of the NCR tech sprint event. The positive participation of our stakeholders did not go unnoticed. This would mark the end of the presentation, and I would like to then hand it over back to Madam Liz to continue with the program. Thank you.
There are questions. Thank you very much, Palesa. So like I indicated, this is the first tech sprint that takes place in Africa. It's not a solution, but it's an opportunity to at least know also who is in the market and who has tools. So we really congratulate the NCR for taking this initiative. So I have to make an executive decision because the people that should tell me what to do haven't told me. So yeah, I'm failing totally. But anyways, executive decision on my end. So raise your hands or put them down if you want to stay. No. I think that they are going to take the food away at 2. So I think we better take a lunch break. Please go quickly, take a rest, come refreshed, because this continues. We are back at 2.
Thank you. Good, good.
So? What? Huh? You want it now or what? Where? Here? So, welcome back. I see the people coming in. So maybe we can get the panel situated. Charlotte Finlay, she is from SACRA. She will moderate the panel on enhancing compliance and resilience of small credit providers through digitization. And the panelists can come through also if they are not at lunch, which seems they are. Ariel Wicos, Leonie, haven't seen you for a while. Faith. It's all yours.
Good afternoon, everyone. I hope you had a lucky lunch. So most of us are not well known, so I'm just going to do a quick introduction. Well, wait. Let me just say that we're not well known yet. All right, so I'm Charlotte Finlay, and I'm a portfolio manager with the South African Credit and Risk Reporting Association. I oversee most of the affiliate-led group memberships. Now, today we're going to delve into the critical a critical impact in the financial ecosystem, which it's a critical impact in the financial ecosystem, digitization and its role in enhancing compliance and resilience for the small credit providers. So on our panel, we've got Faith from the NCR, we've got Mariette and Vickers from Delta IT, and then we've got Leonie from Microfinance. All right. So Faith, I'm going to start with you. I'm just going to do one of the questions that we put on the list. So what specific compliance challenges do small credit providers face when implementing information and communication technology systems? And what regularly support or guidance is available to help them navigate these challenges?
Hello, can you hear me? Is it audible? Okay, thank you very much, Charlotte, for the question. I think the small credit credit providers are having a lot of challenges, and those not only compliance or regulatory related only. I think the previous panel and the previous speakers or the presenters have touched based on a lot of other issues that they are facing. And maybe if I can just repeat few of those would be the issues of affordability, the infrastructure issues where there's still challenges with internet connectivity, because most of our credit small credit providers are sitting in rural or non-metro areas. So they are still struggling with those kind of challenges. As much as COVID-19 was a catalyst in most of the other organizations in terms of accelerating the use of technology, the small credit providers were impacted negatively. Most of them could not even be, they are still not being able to get back into their feet, and most of some of them even closed off. So we are aware of those challenges. As far as regulatory issues are concerned, there's compliance related. Our regulation 1913 is expecting the credit providers to be sharing information with the rest of the other participants of our ecosystem, and because of the affordabilities, because of the internet connectivity or the lack of infrastructure as far as technology is concerned, they are still unable to do so, and they are still unable to they're still unable to comply with that regulation. As a result, Colin and the other team have indicated that as part of our phase 2 that we are launching today, we're having an automation, which is an automation strategy to ensure that we actually find a way as an organization to assess what are the challenges that are there, what are the opportunities in order to be able to put some kind of a integrated and seamless infrastructure or systems that we can be able to attract other stakeholders, other participants within our ecosystems, especially the small credit providers, and give them access to such systems. They talked about the alternate data earlier, and without technology, without digitization from the side of the small credit providers, they will not be able to benefit from that. So we are actually trying to assess those possible opportunities in collaboration with all our other stakeholders in order to ensure that we put something in together that is going to be used by all our NCR stakeholders in sharing that information. The tech sprint was also one of the the things that we wanted to explore as an organization or as a regulator to check if there's available systems or solutions out there to assist the small credit providers in participating in all the rest of the other processes that we require. So we're still looking at seeing the outcome of the tech sprint as we've got other stakeholders, other winners that are still in the incubation. Lastly, as the regulator, we have actually strengthened our education and empowerment through the road shows that are now not only focusing in the metro or the large and the medium credit providers, but we are now focusing in the non-metro areas or the rural areas and using the languages that they could understand in explaining the regulations, because during as a build up to the tech sprint, as we had most of the round tables, they have indicated that we are using a lot of jargons when we communicate to them or when we issue regulations. So we're trying to reach out to them in the languages that they best understand us, in order to educate and empower them in understanding all the regulations and all the associated regulations. Thank you.
Okay, thank you so much. Next one, Mariette. How have the recent disasters affected, firstly, your service to credit providers?
Thank you for that, Charlotte. I'm going to ask you if we can address both parts of the question, if you can just read the second part as well.
Okay, so the first part is, how did it affect your service to credit providers? And then from your vantage point, how do you see the credit providers being affected?
So these were trying times for everyone. No one could do business. We were faced with the same problem that time. During all of these disasters, during COVID, the public needed more credit, more so than ever before. And they couldn't travel. They couldn't get to their local microlender that they've been going to for years. So we came up with brilliant solutions for them. We saw a major uptake in web loan systems. And this also speaks to what we addressed earlier, the embarrassment and disappointment of, but what if I don't qualify? First of all, you're not allowed to travel. What if you get there and then you don't qualify? So now this is perfect. The consumer can apply online. He can check if he's going to qualify. And then during the lockdown times, when they couldn't travel, they would apply online. So we would then set you up with a web loan system. You've got your WebFin system that we have as Delta IT as well, where you see if you qualify as a consumer. It sends a message to the microlender. He sees he's got a new application. He can review the application. He can do his credit check, and he can then let the consumer know, wonderful, you qualify. I can help you. And then they can do a transfer for him. They can pay out in a different method. They never had to see each other. So we then also realized that we shouldn't do business the traditional way anymore. We have a very big account manager base that we have a national footprint, and we service our customers and our merchants countrywide. And then we said, let's do this a different way. We are now going to concentrate more on our cloud-based solutions where we can offer remote support. We can log in on your system. We can see how we can assist you. We even did training. We had so many merchants coming to us for our solutions. And we also saw a huge uptake in DebiCheck solution TT1, where you never have to be face-to-face with that consumer. And then we would put these bundle packages together for our merchants. And we had so many referrals as well, because we found that, guys, we don't have to see each other anymore. You don't have to see your consumer, and we don't have to see you for us to give you our solutions. And now it's business 24/7. Also, we found that our merchants have now a wider footprint. They don't just have to service the local community. They can now do business with someone they've never met before, because we made it so much easier for them. And we just found that these solutions work for everyone. People don't have time to leave work and go to the microlender down the road and stand in a queue during his lunch break, go to the bank and get bank statements. They can do everything, and then again,
I don't have to be embarrassed to get there and see that I actually don't qualify. I can check before the time if I qualify and then get the transaction done remotely. So that is how we came up with solutions, and we're continuing with these solutions, and it's really working for everyone. Thank you, Charlotte.
Thank you so much. Another one for Delta IT, because the credit providers that do not comply with Regulation 1913, what in your view is the reason for that?
So thanks for the question there. So most of the time, I think it's more of a lack of understanding what the regulation actually entails. The Section 90. Why do I need to submit data? What benefits would my company actually get from submitting data? So the main challenge is there. We've got about 2 systems at the moment in the market, which is our Dolphin system. We've got about 1,500 companies using that software daily. Then we've got our Webfin system, which is about 1,580 now. 1,580 now last check. Now the main challenge of the guys is they don't really understand why and the benefits. And as soon as you really start explaining what the benefits are, if you upload and share your data through the Sakra Hub, it gives you a better overview of your client's finances. It obviously gives you a better idea of how many other loans he has in the market in your specific area, which then gives you a bit of an override to make good business decisions for your client, and obviously not over-indebting the client. Because there's a lot of strategy getting people financial assistance, getting them into the market, which is a very important part. But we also need to remember there's a coin on it, on the sense of it, as soon as you start over-indebting clients. That's even a bigger challenge for that specific client, because then you put him in that trap where he will never come out. So that's where system stability and your integration setups via the Sakra Hub through to all the credit bureaus, which we are integrated with at the moment, Experian, TransUnion, XDS, and Very Credit at the moment. So our systems have got all those portals, which you can use at any time for the clients and our micro lenders to really see live what has happening on the system there. So it's not really a lack of not want to comply. I think it's more of an understanding of it, because most micro lenders want to be compliant. They do not want to our investigator to go and visit them and say, you are not complying. They want to be compliant. Now, it's ourselves as a loan management system providers to give them the tools to be compliant as best as possibly we can. And then from there on, obviously, you look at systems to make it easy for them. We have now decided, obviously, we saw that gap in the market. So we've started last year to get an actual training team involved. So we've got 8 trainers in the whole South Africa at the moment. Each and every new system that goes out in the market, that trainer spends a whole day at the client's premises, or if the client provides, if they want to do it remotely. You will then get your training sessions there. You will be explained how the actual initiation fee, the service fee is calculated, why it is calculated in that sense, why the affordability is connected on a 3-month basis, why we are looking at affordability in an average wise, that you can really make good business decisions. Because at the end of the day, your collection rate will go down if you do not do your affordabilities on your consumers. So that's a quite important part there. So I hope I've answered your question there.
Yeah, thank you very much. All righty, then I'm going to pose one for Leonie now. Small lenders, the biggest thing that the small lenders always say is it's unaffordable to be compliant. So do you have any thoughts from the association on the type of pricing models that credit bureaus, large lenders, service providers can consider throughout the value chain?
Great. Good afternoon, everyone. I think we got the graveyard shift, and I can see a lot of people yawning and looking down. So please stay awake. We've got interesting information. Thank you so much for the question. My name is Leonie van Pletsen. I represent Microfinance South Africa. We have about 1,500 registered credit providers associated with us. Now, I can give you a very long story and I can really bore you guys to sleep. But I think our biggest problem is the cost of compliance for microfinanciers. So if we look at the National Credit Act, actually at the FIC Act, at the POPI Act, we are looking at a one-size-fits-all approach. But I think we should really start investigating a tiered regulation approach. You know, regulation that is focused on a specific product in the market, because we are over-regulating at this stage. And that is scaring the microfinanciers. Now, when we think about systems, the systems that our members use, those are the professional members. Those are the guys that knows how to do business. MFSA has been traveling through South Africa. We are talking to the illegal credit providers. We are trying to transform them and actually almost rehabilitate them. But when you throw them with 702 layout, submitting data, the hub where you share information, you lose them completely. We really have to simplify the compliance and say, guys, let's look at a tiered regulation approach. For credit providers within this regulation or in this category, this is going to be the rules. Just submit something so that we can see some information. You don't have to submit everything. You don't have to comply with everything, because we have to comply with the National Credit Act, with the FIC, with POPI, Consumer Protection Act. There's so much we have to take into consideration. Now let's take it back a bit and say, you know, if we look at bigger credit providers, they're looking at a turnover per month of 2 million rand. Some of our members' turnover per month is 12,000 rand. Now, if you look at 12,000 rand, what you can actually make of that 12,000 rand and the loan sizes, they are not making a lot of money. To use these systems are expensive. To submit data is expensive. And it's not just expensive for our members, the development is expensive. So this is a whole rethink that we have to go into. And I'm really not giving you a solution now. But if I think the one change that we should make is we should not start looking at products tiered regulation and not over-regulation. So from my side, that's the information. I just want to add on the previous comments, specifically on development finance. I think our members they offer a huge opportunity in the development finance space. We are already serving consumers in the rural areas. We are situated in the rural areas. So I think there should be some outreach to our credit providers to say, here's a system, here's data that can assist you, because our members has got an appetite for development finance. Rural Finance is a member of the association. We're very proud of what Mariette and her team did. And I'm telling you now, if there is innovation, if there is structure, our members will really take their own capital and they will invest in this. Obviously, they will not take all of their capital, but I think if your business runs on a dual module of consumer lending and development finance, we may have something that we can work with.
Thank you so much. All right, so Colin pressed me a little bit for time, so I'm not going to open the floor for questions. We will have questions for after the session. Thank you, everybody.
Thank you so much. You are very kind. And we will be back with questions, because actually, I think it opened up a set of opportunities to really have a conversation, particularly with the regulator. And we need to resolve this issue. But anyways, we appreciate and take the time. We are going to start on session 3, and this is on business credit and risk reporting. We are going to start with a presentation from Charles Samel, chairperson of SACRA, for the keynote of BISCRE. The clicker is there.
Thank you. Afternoon, everyone. Thanks to the National Credit Regulator and the IFC for inviting me to speak during this important launch of the South African Credit Reporting and Financial Inclusion Program. As SACRA, we appreciate the inclusiveness and the collaborative approach that the NCR and IFC have taken in conceptualizing and implementing this program. In speaking to you today about SACRA's Business Data Sharing Initiative, I'm firstly going to focus on the lackluster state of SMEs in South Africa, and then look more closely at access to finance and the intended role that SACRA's Business Data Sharing Initiative will play and where we are with it. So let's get going. I mean, if they got the graveyard shift, then I got the graveyard shift after the graveyard shift. So this can't be business as usual. So let's start off with a different approach. Am I going backward? Let's start off with a different approach, a South African approach. Sanbonani. Yebo Sanbonani is the response. Yes, what is Sanbonani? It's the plural of I see you, Sawubona. Yebo Sawubona, you see me. The response, Chiboka, I exist for you. We are saying more than hello in South Africa. In exchanging these greetings, we are recognizing each other's worth and dignity. We are saying that we see the whole of each other, our experiences, our passions, our pain, our strengths, weaknesses, and our future. You are valuable to me, so I am to you. Another response is in Ngikona. I'm here. Until you saw me, I didn't exist. By recognizing me, you brought me into existence. We are interdependent. Our relationship is mutual and reciprocal. These are more than greetings. They are ways to vitalize each other by giving our full attention and presence, communicating how much we each value each other. I see you by being with you, not intermediated by others or technology that distorts our relationship. You matter to me. South Africa, with its many challenges arising from disparities of income, education, opportunity, and hope, has tried hard to hand out resources for people to provide for themselves by granting them sufficient money to meet their minimal living needs with dignity. Over the last decades, we've made progress in this respect, but clearly there are financial limits to our ability to do so. Our GDP growth in recent years has been dismal, and our unemployment rates shocking. If we think about load shedding, we are people shedding, and we are in stage 10.